The magnitude and the severity of the trade restrictions are in doubt.
Many companies are on pause. They're waiting to see what's going to happen.
One thing that we have seen has been a willingness by the administration to extend deadlines related to tariffs.
What can happen from a policy standpoint can change any minute.
Data, the administration, trade is so volatile. But at this point, I think that we've really seen the worst case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance in a new week, a new month with a lot of the same problems. Trade tensions piling up between the U.S. and China yet again, with both sides accusing the other of violating recent agreements. Washington, D.C., meanwhile, shrugging off bond market worries, despite Jamie Dimon's warning that the market will, quote, crack under the weight of the deficit, and Wall Street counting down to payrolls Friday at a time when traders have no idea what to do with data these days. Annmarie, I've got to say, Peter Scheer of Academy Securities summed it up for me over the weekend when he said, for me, sentiment surveys are on the cusp of shifting from confusing to irrelevant. Even the establishment data is not getting the kind of survey responses that usually warrant any kind of particular credibility or support.
Well, what does the data matter when the policy is still so uncertain? And what we hear from corporate America, from what we hear from the Fed, is that everything is on pause. Everyone is wait and see because they're waiting for policy certainty. And we begin today with more policy uncertainty. We thought we had this détente between Washington and Beijing, the world's two biggest economies, and yet we're back to square one. And there's a lot of flame throwing right now and rhetoric when actually the market was almost arguably set up for something more positive.
So let's talk about where we are. We had this idea of a 90-day pause, and then suddenly these recriminations start going on where both sides are saying the other violated. And now it's back to who's going to call who again between Xi Jinping and President Trump?
Exactly. And Kevin Hassett, the director of the National Economic Council, said yesterday on the Sunday shows that he was expecting a call this week between President Trump and President Xi. After Friday, this time on Friday, we got that Truth Social from the president talking about that China is not living up to what they agreed upon in Geneva. China has come back and said, actually, that's not true, and it's the United States that is creating issues when it comes to AI export controls on chips, revoking visas when it comes to Chinese students. So now there's a multitude of issues right now in this détente we saw out of Geneva.
How likely is it that we're going to get some sort of phone call between the leaders of two countries at a time where you're talking about visas getting revoked for Chinese students, you're talking about slow walking the rare earths export license from China, and you've got a lot of pretty volatile language coming out from both sides?
Well, here's the thing. I think before there is going to be a call, everyone's going to go in with their maximalist approach and hottest rhetoric. So potentially we could see a call today. And even the Treasury Secretary is also leaning on at some point there will be a call. But I'm sorry, not today, this week. But the Commerce Ministry of China has come out with some pretty harsh words. So potentially Beijing is going to look at this and say, we're going to slow walk this, because something the United States has made really clear, they want those licenses when it comes to the critical minerals they need for the industrial supply chain.
Yeah, the language out of the Chinese Commerce Ministry, if the U.S. insists on going its own way and continues to undermine China's interests, China will continue to resolutely take forceful measures to safeguard its legitimate rights and interests. Meanwhile, we also have, of course, the budget discussions that are ongoing in Washington, D.C., with the Senate reconvening and possibly taking up the reconciliation bill. This is going to be quite a fight at a time where you have Wall Street officials, and yes, Jamie Dimon's been sending out this warning for quite a bit, saying this time is different, the deficit looks more concerning, and we will act quickly if we don't like what we see.
Exactly, but for years, Jamie Dimon has been saying Washington, D.C., the government has been spending like drunken sailors. And they are. And this bill, this tax and spending bill, they will spend. One thing the Treasury Secretary did push back on this weekend was the fact that the CBO does not take into consideration other things the Trump administration is considering when it comes to the extension of TCJA and some other priorities of the president, things like the tariff revenue they are bringing in and also what this could mean for growth. But Jamie Dimon was talking about when it comes to the bond market breaking. Terry Haynes, we're going to speak about, actually says this helps the Trump administration. They could talk about more spending cuts because they could say, look, even Jamie Dimon is talking about how our deficits are ballooning and the bond market might crack.
Well, this is going to be something we'll be debating throughout the week. Meanwhile, we are seeing a little bit of softness coming off the biggest monthly gain in 18 months, the biggest May performance going back to 1990. Today, we're taking back just a bit of that, down about 0.6% on the S&P. You are seeing yields just marginally higher across the board. 10-year yields 4.44. And you could see crude popping. And this is something we're going to get to in a little bit on the heels of a number of attacks overnight between between Ukraine and Russia ahead of talks today, supposedly taking place in Turkey. Coming up this hour, we've got Russ Kosterich of BlackRock as trade uncertainty weighs on stocks. Former Trump White House trade official Kate Kalukowicz with U.S.-China trade tensions back on the table, and Matt Hornbach of Morgan Stanley predicting yet more dollar weakness. We begin this hour with stocks lower as tariff concerns weigh on markets once more. Russ Kosterich of BlackRock writing, elevated valuations of the potential for further economic disruptions suggest a trading range rather than a quick sprint to new highs. Russ joins us now. Russ, I got to tell you, every single note that I read over the weekend said the exact same thing. It's going to be a trading range. It's going to be choppy. How are you trying to get an edge in this?
Well, good morning. I think there are a couple things. Again, it's probably no big surprise that people are seeing the challenges you're going to have to, putting new highs in the near term. But I do think we've learned a couple of things in the last few months, one of which the economy is still, as of now, fairly resilient. Second, while tariffs are going to impact prices in the near term, and we probably haven't felt the full effect yet, at least we're going into the situation with inflation coming down, getting closer to Fed's target. So that's a good thing. And finally, earnings were surprisingly good in Q1. So we are thinking about this as a range. One of the things we've been doing, which has worked very well the last few months, is using volatility as an asset class. Thinking about times in the market when you're close to what we would define as the upper end of the range, selling upside, using volatility to manage your downside. Because again, this is a very different market than we had in 23 and 24, where the market just sprinted 20, 25% a year. This year, we've had a ton of vol, and we're within spitting distance of where we started 2025.
Russ, to pick up on your point about the earnings, just that's one piece of the larger puzzle that you were just laying out there. It's something that a lot of people really honed in on. Julian Emanuel of Evercore ISI saying that this is one of the strongest earnings season blowouts since 1992. Lori Calvasina of RBC Capital this morning upgraded their expectation for year-end S&P 500 targets on the heels of some of this earnings performance. Does that make you more bullish on the margins for U.S. equities than you were before the earnings season began?
So certainly I feel better about it because I do think you came out of the earnings season with a couple of things. Not only were the overall earnings strong, one of the things you've noticed in this market is that really since around mid to late April, it's been the mega cap tech companies that have led. And a lot of the strength we saw in earnings season was because of those companies. And if you remember back to January, even before the tariff situation really became exacerbated, there was a lot of concern about would companies spend on AI? Did the DeepSeek news disrupt the narrative about spending on data centers and other types of CapEx? And so far, we have not seen that change. We've still seen a lot of very strong investment by the hyperscalers, and that's given some people confidence in that AI trade. The caveat to all of that is a lot of companies maintain guidance in Q1 into the rest of the year, not so much out of a table-pounding sense of conviction, but more because they just don't know. There's so many uncertainties around policy, around tariffs, about the breadth of the tariffs, that it's still very hard to say with certainty how they're going to affect the economy going into the back half of the year.
What could be the new catalyst then for new highs? Is it going to be trade certainty?
I think certainty would definitely help. I think if we knew the extent, if we were able to plug some numbers into assumptions both about earnings and the broader economy, have a better feeling for what the downside is likely to be in terms of growth, yes, I think that's one catalyst. But the other one is still going to be some of these fundamental bottom-up themes that have really driven the market the last few years. And again, I turn back to some of the resilience we're seeing in mega cap tech, which is really what has helped the market move nearly 20% off of those lows we saw back in April.
But when it comes to mega cap tech, and I'm thinking of companies like NVIDIA at the moment, does it concern you that the Trump administration is really ratcheting up export controls and they want to de-risk when it comes to semiconductors and how much of those can get into China?
Well, just with the tariff situation, again, if we don't know all of the regulatory environment, that's going to create uncertainty, that's going to create a little less conviction. One thing that I think helps in this space, you had this massive correction in those names that actually began last year. It accelerated in January after the DeepSeek news. And of course, we saw the worst of it back in March and April. As a result, again, I don't think I would describe many of the names in this space as cheap. But relative to the broader market, we've seen a pretty significant repricing versus where we were at the peak last summer.
You say in your notes that you have a 3 to 4% position in gold as a hedge against policy uncertainty and also what's going on with the deficit. Is that enough at this moment?
It actually has worked very well. I mean, we've done a lot of analysis on what's the right position. Of course, there is no right answer, but I think that's probably around the right level. And one of the things that it has done, again, I know we've spoken about this in the past, if you look at gold day to day, it's not necessarily a perfect hedge. It doesn't work as reliably in the short term as, for example, U.S. Treasuries did last decade, when there was that very consistent negative correlation between stocks and bonds. But in general, what are you concerned about in this environment? You're concerned about uncertainty. You're concerned about equity market volatility on the back of that policy uncertainty. And you're also concerned about that long-term deficit and thinking about a store of value. In that context, gold works very well. And even though it's not a huge amount, we found it really has been a risk mitigant during the first half of the year.
And going forward, this is one thing that we're watching this week is the Senate coming back to Washington, D.C. and marking up the reconciliation bill. And a real question, especially as the likes of John Waldron of Goldman Sachs and Jamie Dimon of J.P. Morgan coming out and saying this is going to be a real problem if Washington, D.C. doesn't get the deficit under control. How much do you see this time as different? That this is a bond market and this is an investor base that is ready to protest in mass if this bill doesn't pass muster in terms of deficit reduction?
Well, I think this is the key question. Honestly, this is coming up in almost every client meeting I had. There is more focus on the deficit. I think there is more concern than I saw 5 or 10 years ago. Having said that, as we all know, the time is extremely difficult. When does this become a problem? Clearly, it's more acute than it was, let's say, 5 years ago, in the sense that we're talking about bond market auctions, not just in the U.S., but also in Japan. That's something I don't remember as much in recent years. So how to think about it, again, there are parts of the bond market we really like. The short, the middle part of the curve, high quality spread has been a key part of the portfolio. But as we've spoken about in the past, we do remain a bit more cautious on the long end of the curve, because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Russ Kosterich of BlackRock, thank you so much for being with us. And it's something, Annmarie, that we keep hearing about, the idea that the 30-year Treasury is a risk asset at a time when it's very hard to calculate what the future might look like.
And that's why everyone asks whether or not the bond market is going to have a seat at the table when it comes to this vote for the one big, beautiful bill. We're talking about the Senate coming back. They have such a tight deadline, July 4th, to try to get this done. Every single senator on the Republican side is basically a king. Thune can lose 3 people because the vice president could be a tie-breaking vote. Well, there's a lot more than 3 people that have issues with this current reconciliation bill that was sent over by the lower chamber.
That's something that sounds like it's a recipe for a mess when everyone thinks that they're a king in Washington, D.C. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. China is accusing the U.S. of violating their recent trade deal and vows to take measures to defend its interests. The Chinese Ministry of Commerce is rebuking President Trump's claim on Friday that Beijing breached the consensus reached in Geneva last month. White House National Economic Council Director Kevin Hassett believes the 2 leaders could talk this week. Meanwhile, several people were injured in Boulder, Colorado in an attack on an event being held to support Israeli hostages. Police say the weapons appear to be bottles of flammable liquid, and a suspect is now in custody. Colorado Governor Jared Polis issued a statement condemning all hate-filled acts, while Boulder's police chief says it's too early to determine if the motive was terrorism. And former Fed Vice Chair Stanley Fischer has died. Fischer served as vice chairman of the Fed from 2014 to 2017, following 8 years as governor of the Bank of Israel. He mentored a generation of policymakers at MIT, including Ben Bernanke, Mario Draghi, and Kazuo Ueda. Fischer was 81. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, never going to default.
The United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
Terry Haynes of Geopolitics joins us coming up next on a day we're taking back a little bit of the gains that we saw last month. This is Bloomberg. coming into a new week, a new month with just a bit of losses after the biggest monthly gain in 18 months going back to 2023. This morning, we're taking back some of that across the board, led by some of the biggest gainers, the big tech names. NASDAQ down by almost 0.7%, S&P futures down by 0.5%. Yields are higher, dollar weaker. That is a continuation of what we have seen in the past. And this comes with, under surveillance this morning, never going to default.
The United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall. The deficit this year is going to be lower than the deficit last year, and in 2 years it will be lower again. We are going to bring the deficit down slowly. So the goal is to bring it down over the next 4 years, leave the country in great shape in 2028.
Here's the latest. Treasury Secretary Scott Bessent pushing back against concerns the U.S. will not meet its debt obligations. Republican leaders in Senate set to begin negotiating President Trump's tax bill, which includes an increase in the debt limit this week. Bloomberg's Tyler Kendall joins us now from Washington. Words you never really want to be saying. We're not going to default. How much of a concern is this on Washington, D.C. as the Senate heads back to deliberations?
Yeah. Hey, Lisa. Good morning. Well, it probably depends on who you ask and how motivated they are to really make this a focal point and a priority. As we know, one of the biggest issues of doing this as one big, beautiful bill is that there's other priorities on the table that Republicans are ultimately trying to get through. And in fact, Lisa, I actually posed one of your top questions to members of the House when they were negotiating this about whether or not they were looking at the bond market here. And you had members like Congressman Tim Burchett, a Republican from Tennessee, telling me, yes, he thinks, in fact, it's a canary in the coal mine. But then ultimately he ended up voting for the legislation as it stood. Now, the administration, for their end, really has been focusing more on what they say will ultimately grow the economy. I was at Treasury Secretary Scott Bessent's latest testimony on Capitol Hill last month, where he said that, yes, this bill will contribute to long-term debt in this country, but they're more focused on stabilizing the debt to GDP ratio, which he says will happen if the administration is able to implement what they think are pro-growth policies. But of course, a lot needs to really happen here at the end of the day. Treasury Secretary Bessent pointed to tariff as a revenue raiser as one example in some of his interviews over the weekend. But the question really becomes, is the Senate going to make some sort of meaningful changes to ultimately address this issue? And perhaps one of the biggest sticking points here is when it comes to lifting the debt ceiling. That could really be one of the areas that needs perhaps the most negotiation. Lisa, keep in mind the House plan would lift it by $4 trillion, but the Senate blueprint had originally called for lifting it by $5 trillion.
Taylor, I said earlier that everyone in the Senate is a king. The margins are just too slim. Who are you watching to make sure that this bill actually gets passed?
Annmarie, there are a few key senators that are emerging here. One is Rand Paul, a Republican from Kentucky. In fact, it seems President Trump is watching his vote as well. He singled him out in a post on Truth Social over the weekend. Lifting the debt ceiling is really one of the biggest issues here for Senator Paul, who has said he's not going to vote for any legislation that would do as such, and doubled down on his position in some interviews over the weekend, saying that at the moment the math just isn't adding up for him. He's sort of falling in line with some other members who are sort of pitching themselves as fiscal hawks, including Mike Lee of Utah, Ron Johnson of Wisconsin, and Rick Scott of Florida, who's really considered to be a key ally of President Trump's. And then on the other side of this, watch closely those more moderate senators who have said that they have some issues with those changes to Medicaid, such as Lisa Murkowski or Susan Collins. And then lastly, Annmarie, keep your eye on Josh Hawley of Missouri. He's someone who's really trying to thread the needle here when it comes to his broader support of the package, but has said that he does not like any changes to Medicaid, and he wants to see perhaps some bigger pullbacks when it comes to those IRA subsidies. Just another thing in this big, beautiful bill that we're closely watching.
Tyler Kendall, thank you so much. As always, we'll be catching up with you in just a little bit. Terry Haynes of Pangea Policy joins us now, and Annmarie nailed it. The line of the weekend really stood out to me from you, which is that Jamie Dimon's comments about the bond market potentially cracking somehow helps this administration. How does that make sense?
Well, thank you for that, first. And secondly, I follow that context because I read Bloomberg. So, and Bloomberg, I thought, reported very well on Dimon's comments. But Dimon's point was that if there's a crack in the bond market, firstly, it could be in months, it could be in 6 years, I think he said. It's because of essentially the decade plus of fiscal incontinence support. These are my words. Fiscal incontinence supported by accommodative monetary policy. So that's short of full-throated support for Trump and Bessent. But what it does say, and what I think the White House probably picks up on, is this is a mess we didn't create, and it takes us a while to unravel it. And you heard that in Bessent's comments loud and clear yesterday.
Well, Terry, what's the alternative? Americans' taxes go up next year?
Well, yeah, essentially, yeah. I mean, they're up against the wall in that sense. So they're not going to preside over anything that increases Americans' taxes, so they won't. And Bessent's comment, of course, was essentially Rome wasn't built in a day, and neither was this situation, and we're going to decrease the deficit gradually over time. I think what Bessent isn't saying, I don't think he's hiding it, but I think what he isn't saying is the bogey everybody's really looking at isn't debt or deficit, it's debt service. And debt service just became the largest category of spending last year for the first time, and they are focused on getting rid of that, largely because you can't be a great power for very long and have your wealth sucked into the black hole of debt service.
When you see the bond market pushing back, Terry, is it about the uncertainty regarding trade policy? I mean, just over the weekend, we also potentially are going to see 50% now on steel and aluminum, as well as all the tit for tat regarding China. Or is it about the spending plans and the one big beautiful bill?
I think it's a little bit of both, frankly. I mean, there's some restiveness generally. It's not just the United States, as you all know, about the spiraling levels of debt across the board, whether it be United States, whether it be the UK, European Union, whether it be China. And Bessent's point about China is correct. It's not in great shape itself. So they're trying to do what they can to force a deal there.
Terry, when you talk to people in D.C., how concerned are they that the three-pillar stool is kind of having some issues, is getting a little bit wobbly right now with the increase in tensions between U.S. and China, as well as this question about how quickly they can get through this bill?
It is much clearer in Washington than it is to markets, for whatever reason, that so much of this has to do with geopolitics. My top theme, as you all know, is geopolitics is essentially, for the United States, is essentially driving economic policy. They see it very much that way, too. That's very transparent. Concerns alone about the lack of defense industrial base have been mounting for years. And the way to look at the manufacturing push, the way to look at what happened with U.S. Steel and Nippon Steel is an attempt to address that, frankly. And it's the major reason why Trump and Republicans are going to continue along to try to put the United States economy in the best growth position to counter China and be much more attractive partners to countries from the UK to Australia to India and everywhere in between.
Yeah, but is it working, Terry? I mean, this is what I'm asking, given the fact that China and the U.S. seem to be at an impasse. There's a question about how quickly some of these other deals can get through, given the fact that we keep hearing deals are going to be announced any day now.
I'll take the glass half full on that. Again, my bogey on this is probably around July 4th, partially because that's what Trump wants for the tax bill, partially because a lot of the other trade-related things, major trade deals and the like, as well as decisions on reciprocal tariffs, are all scheduled to hit at that time. So what they're hoping is that they combine a series of events that provide a much more positive market direction and a much more positive look for the United States economy.
Terry Haynes of Pangea Policy, thank you so much for being with us this morning, and good luck this week. I do wonder, Annmarie, how close some of these deals are. We have heard Kevin Hassett talk about there are a couple of deals that it could be announced any day now. We've talked about Japan. We know that the UK was announced, but there's still some details that are trying to get worked through.
Yeah, and the UK now has questions, talking to the Financial Times over the weekend about what the 50% new aluminum and steel tariff level might mean for the deal that just a few weeks ago they already inked.
And it does look like potentially Canada and Europe are the ones that end up with the biggest part of that. Coming up, we're going to discuss this a bit more. Former Trump trade official Kate Kalukowicz, as U.S.-China trade tensions ramp up yet again. From New York, this is Bloomberg. Coming into a Monday with a bit of a softer tone after the biggest May performance for the S&P 500 going back to 1990. The biggest return, more than 6% going back 18 months since 2023. Today we are softening a bit, led by some of the biggest winners are becoming the biggest losers. NASDAQ down about 0.7%. Take a look at what's going on in the currency space. We have seen a consistent dollar weakening trend, and that continues this morning with now the euro at the strongest versus the dollar in more than a month going back to late April, and it goes at a time when Morgan Stanley is talking about the dollar poised to weaken an additional potentially 9% over the next year, with many other banks piling on and saying the same. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with steel stocks soaring after President Trump said he'll double tariffs on steel imports from 25 to 50%. So the big winners are American steel companies like Cleveland-Cliffs. Those shares are up more than 30%, as well as Steel Dynamics and Nucor. And just to give you an idea of where we stand, the U.S. still imports 17% of its steel. So yes, this move will help domestic producers, but it's a headache for those in the auto and housing sectors, which will see material costs rise as a result of these staggering 50% tariffs. And speaking of autos, we are seeing shares of Stellantis falling nearly 3% now, some of that having to do with the steel tariff impact, since it does have factories here in the U.S. But also, we got numbers out of France for new car registrations showing overall weakness in the auto sector there, and the declines were led by Stellantis. And last up, we end on some M&A action. We are seeing Blueprint Medicines up to nearly 27% now after Sanofi agreed to buy the U.S. biotech for $129 a share in cash. That represents a 27% premium to Blueprint's closing price on Friday, and that is a hefty price in a market where pharma M&A has been cautious. We haven't seen big deals like this one out of pharma this year. Lisa?
Thank you so much, Yahaira. And it seems like a bit of a merger Monday coming back, which is actually notable after the absence of any such deals earlier this year.
Yeah, potentially they're feeling like it's a green light to actually do something, maybe a little bit more of reading the tea leaves in Washington, D.C. and the push for deregulation, easier business environment out of the Trump administration.
So how do you read this tea leaf? On our radar this morning, China accusing the U.S. of severely violating their 90-day trade truce, saying the White House is imposing new discriminatory restrictions with its AI chip export guidelines and design software sale curbs. This just puts another potential wrench in the works when it comes to this ongoing discussion.
Right, and it's a flare-up, new war of words between these two after we saw that détente. But that détente was just a month ago. The question I really have going into this week is, now that we have this war of words between Friday and today, between Washington and Beijing, what does this mean for the call that we were expecting between Xi Jinping and Donald Trump? And we're expecting that call because the White House told us they were expecting a call this week. And you have to just wonder, does this just diminish that? And that means that potentially this is going to be further pushed. And this relationship, which seemed to be moving in the right direction in terms of dialogue, is now put on ice.
We're going to be talking more about this with Kate Kalukowicz, which I think is going to be a really important conversation, in part also to understand what are the ultimate goals, because I feel like that's part of what's getting lost in this conversation. What does this new trade relationship even look like? We'll get to that in 1 second. In the meantime, the European Union saying it's prepared to impose countermeasures after President Trump threatened to double tariffs on steel and aluminum to 50%. Existing and new EU levy measures are set to take effect on July 14th. It feels like we're moving perhaps a bit further away from some sort of détente here as well.
So the EU had paused those countermeasures, but they have a list somewhere. So when they say they're going to come out and respond to this 50% new tariff, potentially a higher threshold on steel and aluminum, what does that mean when it comes to the EU countermeasures? They have that list. Are they just going to ratchet up their tariff level as well? We don't know. But I would imagine a lot of this right now is also just tension brewing, why they try to work out a trade agreement. But can they get this done in time? Because they are one of a handful of countries that are also trying to get to the finish line with this administration.
But aren't they actually cracking down on China too right now?
They are. They're looking at the procurements when it comes to China, and they are talking a little bit tougher. Potentially, that is something the United States wants to see out of the European Union before they ink a deal.
The other aspect that people are keeping close eyes on is Russia and Ukraine set to resume peace talks in Turkey later today. The talks come after Ukraine staged one of its boldest aerial attacks on Russia, and Moscow retaliated with a drone and missile attack against Kyiv that killed at least 12 people. Ukraine's attack on Russia targeted planes that were capable of delivering nuclear loads as well as other potential equipment. What do we know about how much this was an escalation?
Long-term planning on Ukraine's part to carry this out. Zelensky said 34% of Russia's strategic bombers were hit. At the same time, then, Moscow did respond, and you saw a barrage of missiles down on Kyiv. And this sets the tone going into today's meeting. Samuel Sharap, who I follow, who at RAND, talked about the fact that when you read headlines proclaiming today's talks a failure, bear in mind the expectations of anything resembling a breakthrough at this stage in the process do not reflect the realities of the war. This is going to be a long, hard slog. And I think those realities were on full display the past 24 hours.
We'll be keeping track of that throughout the day. Turning back to trade, China hitting back at the Trump administration, accusing the U.S. of violating its trade truce. Former Trump trade official Kate Kalukowicz joins us now. Kate, thank you so much for being with us. What's your take on the ratcheting up in tensions that we saw between the officials in China and the U.S. over the past 4 or 5 days?
It has been a whirlwind, I think, in the U.S.-China space. Of course, we saw huge tariffs. We saw those tariffs come down without much else agreed between the two parties. And now this war of words. I think it lends itself to the fact that some of the very baseline issues between the two nations remain very much in place, even though domestic pressure forced both sides to bring those tariffs down. So we're very much in the same space without the tariff pressure, I think.
Kate, is there really going to be an agreement if there isn't some understanding between the two countries on the AI sector and advanced semiconductors?
Well, I suppose it depends on what China is willing to accept here, because I think that it's very clear from the United States perspective that these types of export restrictions on high-tech goods are here to stay. In the big strategic economic competition with China, the focus from both sides, frankly, in D.C., has been to restrict access of these technologies. So unless China is willing to accept that, I think we're not going to see an agreement. They're going to have to decide, I think, whether this is a status quo that they can move forward with.
Is there a chance that the Trump administration gives in more and allows them some more access to this sector?
Well, President Trump, of course, has sent some mixed messages around what he expects and hopes from China. After the tariff détente, the president announced his long-term goal is to do business with China, which, undermines a bit this notion that we could really sever our economies. So I wouldn't say never. The president certainly has shown, willingness to walk back some of his strong rhetoric. But this will be difficult because, in a bipartisan way, Congress has been quite firm on this point.
The rhetoric we've seen, the war of words back and forth over the weekend from Friday to today, could that derail a potential talk that Kevin Hassett said we should expect this week between the two leaders?
I suppose it could, although the signals I see on the U.S. side, at least, are very strong language from the president, softer language, of course, from his cabinet officials. We saw Ambassador Greer, Secretary Bessent try to walk back a bit the very strong tone to say things aren't going great, but we're hoping the leaders will speak. So the U.S. at least is sending a very strong signal that it would like to see a leader-level discussion.
Do we have a sense, Kate, of what the ultimate goal is? It feels like that's getting lost in all of this. Is the idea to decouple with respect to tech between the U.S. and China at a time where NVIDIA is saying that that's not the answer? Is it to just isolate China with the allies that we have, albeit in a somewhat messy way? We don't have a real sense of that through all of this. Do you?
Well, I wish I could help come up with a stronger, clear plan here. The reality is the president has many goals when it comes to economic relationships with the rest of the world. And at times these do appear somewhat to conflict with one another. As I said, I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China. Regrettably, I think some of these other discussions, whether it's with the Europeans, India, others, these steel and aluminum tariff announcements, cloud the the framework of where we're going to go with China. So I'd say we're not quite there yet. I don't know that the president has been as specific as he needs to be with the Chinese as to where he hopes to go. And so we're going to need to have a little bit more discussion before we can see something emerging.
We heard over the weekend from a number of different advisors to President Trump that July 9th is the deadline and it will not be extended past that in terms of the reciprocal tariffs. Do you believe that?
Well, I think the president is always flexible. And I think if we need to go beyond July 9th, we'll find a way to go beyond July 9th. Of course, the president is a bit on his heels given the court decision last week. But I think it means that he's going to show signals that he can move tariffs forward in other manners, as we've seen. We saw the announcement on steel and aluminum. He has quite a few other tools in his toolbox to bring to the ready. So I think other nations really ought to continue negotiating with the United States and keep this date in mind. It benefits them as well to negotiate some deals before the president starts to use these other tariffs. But if we need to extend, I think the president and certainly Secretary Bessent has indicated if we need more time, we'll take more time.
Just quickly, when you talk to your clients, what are the risk dates, the risk events that you have that you flag to them saying this actually you need to keep your eye out for?
Well, when I talk to my clients, I really say, predicting is too late in the game. We need to anticipate big outcomes as opposed to the actual when and the dates and to when they might occur, because we know the president wants to move on large-scale sectoral tariffs. Beyond IEEPA, beyond China, we are anticipating several big decisions this summer when it comes to semiconductor tariffs, pharmaceutical tariffs, copper, critical minerals, and a range of other 232 tariffs. We have impending review of the U.S.-Mexico-Canada agreement. So when I speak to my clients, we're working to prepare for all of these eventualities to ensure that they're well positioned even before a date is announced.
Kate Kalukowicz, former Trump trade official, thank you so much for being with us. And Annmarie, I guess that's kind of what we saw with the 50% steel tariffs. That wasn't on my bingo card. Was that something that was on your radar?
Well, potentially this was the president delivering to a constituency that he said he was going to block this Nippon Steel, U.S. Steel deal, and said allowing it to go through. We're still waiting on a lot of these details, but at the same time saying, but I'm going to make it harder for all of that steel that's coming into the United States to come in. They have no choice now but to buy American.
More on that in just a bit. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. OPEC Plus has agreed to increase oil output for the third month in a row, despite reservations from Russia. Oil-producing nations say they're adding 411,000 barrels a day to the market in July, matching increases scheduled for May and June. The supply hike is seen as a move by Saudi Arabia to punish overproducing members, recoup market share, and satisfy President Trump's desire for cheaper oil. Meanwhile, dozens of people have been killed near two aid distribution stations in the Gaza Strip. Medics and witnesses say Israeli forces fired on Palestinians gathering in southern Rafah and the Netzarim corridor. Israel's military denies those claims based on what it calls its initial inquiry. Meanwhile, a U.S. proposal for a ceasefire that would increase aid to Gaza is in limbo after Washington rejected a Hamas counteroffer. And billionaire Elon Musk said he is not using the ketamine, disputing a report by the New York Times. Musk wrote on X, "I tried prescription ketamine a few years ago and said so on X, so this is not even news." The Times reported on Friday that Musk had used drugs more heavily than previously known during Trump's presidential campaign and that he took ketamine often and also used ecstasy and psychedelic mushrooms on occasion. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, doubting the dollar.
If I'm a long-term investor, I may have my doubts about the dollar, but I want to wait for those, for those doubts to be confirmed. You don't want to be, upstream without a paddle.
That conversation coming up next with Matthew Hornbach of Morgan Stanley. Right now, we are seeing a weaker dollar with the euro at one of the strongest levels that we've seen it going back more than a month. This is Bloomberg Surveillance. Welcome back to a new trading week. Right now, we're looking at a bit of softness in the heels of increased trade tensions. What a surprise after a weekend where there are some headlines. And it is causing a bit of a retracement after last month's blowout returns. We are seeing it led by the tech sector. NASDAQ down 0.6%, S&P lower by 0.5%. You can see yields higher. So this move that we've seen, this sort of negative, this unfortunate positive correlation between bonds and stocks where yields go higher. Bonds sell off in tandem with stocks across the board, although led by the long end. 30-year yields 4.96%. And what you can see in the currency space is ongoing dollar weakness. This question of how much are we seeing a flight from U.S. assets, in particular the dollar, with the euro at one of its highest levels, strongest levels versus the dollar going back to late April. Under surveillance this morning, doubting the dollar.
It's not a story of the U.S. getting worse than everyone, but it's a story where the U.S. falls back into the pack. If I'm a long-term investor, I may have my doubts about the dollar, but I want to wait for those, for those doubts to be confirmed. You don't want to be, upstream without a paddle.
Here's the latest. Dollar sell-off accelerating as trade and geopolitical tensions take center stage yet again. Matt Hornbach and the team at Morgan Stanley looking for the greenback to hit COVID-era lows within the next year, predicting the U.S. dollar index will fall 9% even after the big decline so far this year. Matt joins us now. Matt, it is wonderful to see you. It's been way too long.
Yeah,
Welcome.
Thanks for having me on the show.
Yeah, you guys wrote a really interesting note over the weekend talking about your full year review. The dollar is going to weaken, even though you still see potential upside for other U.S. assets. Explain.
Well, investors in the United States, Lisa, have a tremendous home bias, and we don't think that is changing anytime soon. What we're really seeing is investors outside of the United States take a second look at their exposures to the U.S., both in terms of their asset holdings, but also in terms of the currency exposure that they have related to those asset holdings. So one of the things that we're expecting are investors outside of the U.S. to increase their currency hedge ratios. And that's not something that requires them to sell U.S. assets. They don't need to sell the money that they have in the S&P 500, but maybe they take up their currency hedge ratios. And that is one of the factors that we think will be putting downward pressure on the dollar over the next 12 months.
It's one thing if investors don't want to go into dollar-denominated assets. It's another thing, and I'm talking about international investors. It's another thing if they actually are trying to just hedge against the dollar. It's two different things. And there's this question about the bond market and whether these international investors are wary of parking their money there. How do you see a scenario where yields could go down? You could see a bid into the bond market even at a time of international flight from the dollar.
Yeah, well, this is exactly why we think that in this move to lower yields that we're forecasting, you have a very large curve steepening. In fact, it takes the shape of the curve to levels that existed the last time the dollar hit those lows that you mentioned earlier. So we are expecting the Fed to cut rates, not this year, but next year. We've got the Fed cutting 175 basis points next year. That is way more than you see priced into the bond market today. And that's one of the main factors that drives yields lower. But that move is primarily driven in the short end of the curve. So you get this very large yield curve steepening, and that's going to bring us back to levels that existed before the GFC, we think.
When it comes to the dollar, is the direction of travel highly dependent on trade policy?
It is dependent on trade policy, no doubt. If the reciprocal tariffs were to go back into effect, that's not the baseline view of our public policy strategists, but if we do see something like that, then I think we would have to adjust lower our dollar forecasts. And they're already well below current levels. They're well below consensus forecasts. So we would probably have to change them again if the reciprocal tariffs went back into effect. That's not our baseline, but certainly somewhere in the realm of possibility.
So what are you recommending to go long on if it's not the dollar?
Well, the currencies that we are most interested in buying would be the euro and the yen. Effectively, the DXY index, if you wanted to summarize it, would be the index that we would be trading the dollar short from. But those would be primarily the two currencies that we like the most.
As I was reading your note over the weekend, I was struggling to understand this idea of a much steeper curve, and yet a growth environment that would be conducive for risk assets. I'm thinking about the housing market. I'm thinking about businesses borrowing long in order to make cap expenditures and things of that nature. How do you have that type of scenario when you have a yield curve that looks something like how it did before the great financial crisis?
Yeah, well, we do have growth slowing. That's important. When you talk to Seth Carpenter or Michael Gapin, what they are going to tell you is growth slows, but it doesn't dip into recessionary territory. And it's that type of slower growth, lower interest rate environment that ultimately will sow the seeds for a rebound in economic activity beyond our forecast horizon. Financial markets are forward looking. So by the time we get to the end of our forecast horizon, right, in the end of 2026, you should have some asset prices having a bit more of an optimistic view on what comes thereafter. But that's not something that we're forecasting in the next 6 to 12 months.
How do you price in the deficit, which seems to be the boogeyman for everyone from Jamie Dimon to John Waldron of Goldman Sachs? You have a lot of officials that are coming out and saying this is going to be the U.S.'s Liz Truss moment. How do you shrug that off and say this is something much more pedestrian and normal?
Well, look, I've been listening to investors ask me about these big deficits for 25 years. I've been, talking about bond vigilantes for 25 years. I don't know where they are. The bond vigilantes show up every so often, and then they go hibernate for the next 10 years. So, I guess I'm growing a little tired of it, to be honest. But it is a topic that is worth talking about every so often. And I think the type of deficit expansion that we're forecasting is not a usual type of deficit expansion. By and large, we are extending tax rates that are already in place. This might have a deficit impact depending on exactly what baseline you're operating from. But in terms of the economic impact, we just don't see it. And so you have this kind of very mixed emotion in the bond market. Typically, you get a big deficit, you get a big expansion in the economy, bond yields move higher. That is, I think, clear cut. This is not that type of deficit expansion. So the bond market has mixed emotions. In fact, some of the spending cuts could weigh on growth. It's not a usual deficit expansion.
Is that mostly because at the crux of this bill is just extension of current policy? And if we don't get this bill, this means American tax rates are going up.
That's right. I think our bond yield forecast will almost certainly be lower if we didn't have an extension of these current tax rates. So the extension of the tax rates doesn't do much for the economy, but it does expand the deficit. And so we should see higher supply in the Treasury market, but most investors that we've been talking to for the better part of a year now have already expected that. So I don't think it's going to have a big impact on the market itself.
Just to sum up quickly, it's economic growth, it's not supply. Is that what you're saying?
It's supply, it's not economic growth. So just to twist it. But yes, effectively, we do see more supply, but we just don't see a big economic effect.
Matthew Hornbach of Morgan Stanley, thank you so much. It seems like in terms of what the drivers are for the bond market, it's going to be the economic growth or the lack thereof, and not necessarily just how many bonds are being sold.
A little refreshing in the sense that we have the story out this morning that there's a buyer strike on the long end from Double Line Capital and other investment firms avoiding or shorting the 30-year U.S. Treasury. And to Matt's point, we've been hearing Jamie Dimon talk about drunken sailors in Washington, D.C., the way they spend for years. Not sure why it's exactly this moment.
Well, to be fair, it does seem like people are expecting that steepener, this idea of yield curves going to a very different type of level. And it does seem like people are getting a little queasy of 30-year yields.
Yippee.
Whether that yippee, a lot of yips out there. We'll discuss this coming up next with Sarah Hunt of Alpine Saxon Woods, Bloomberg's Tyler Kendall, Brandon Ferris of the Steel Manufacturers Association, and Aditya Bahave of Bank of America as we parse through all of the economic data, the trade tensions, and potentially what's going on with the naysayers out there of the deficit. This is Bloomberg.
uncertainty is the theme for the market and start to become a headwind for equities here.
The market, has probably some near-term upside, but there's a trading range here.
Yeah, I'm not a buyer of the end of U.S. exceptionalism.
It's back to the U.S. It's back to the U.S. tech.
There is still a narrow path here towards, a better outcome than I think markets are expecting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with another week of trade whiplash. Yes, we have economic data with a countdown to non-farm payrolls, but everything that happens before that may be even more important with rising trade tensions with China and the Senate. Annmarie, coming back to budget negotiations.
I think all of this really centers on whether or not we get another rapprochement, détente between Washington and Beijing, and potentially the breakthrough could be this call that Kevin Hassett told us yesterday he was expecting this week. And then what do we get this morning? More tit-for-tat war of words between Washington and Beijing. The Chinese Commerce Ministry saying Beijing, quote, firmly rejects these unjustified accusations from the U.S. On Friday. This hour, the president was truthing that China has actually gone away from what they agreed upon in Geneva when it comes to these raw materials.
Is that what it is, truthing? I think that's what we have to say now, that he was truthing out there this morning. I am wondering how much there's this battle between the ongoing tit for tat that we see between the U.S. and trade partners and just the nuts and bolts of what drove the rally of the last month, which is earnings have been amazing. And big tech, Danny Berger, has been very much back in focus.
It's been back in focus so much that if you took that out of the picture, the S&P would not be up for the year. It is back up for the year, but it's still not outperforming internationally. It does seem to be that everyone's gorging on trades with this idea that tariffs are negotiations, not outcomes. And that narrative works until it doesn't work. For now, it's working, but does that change at some point?
Meanwhile, people are trying to figure out what's the next catalyst. We did have this blowout earnings season, as Julian Emmanuel was talking about. We have the jobs numbers on Friday. A lot of people talking about this as also a key catalyst. But Peter Scheer put some dampening spirit on that over the weekend, saying a lot of this data is becoming increasingly unreliable because these survey response rates are going down. We don't know what to do with soft data. And frankly, people don't understand what's backward looking, what's forward looking, what's sideways looking, and what's just simply, Danny, irrelevant.
Or if you're Chris Waller, who gave a speech very recently, said even if the survey data is right and consumers are expecting more inflation, the labor market's so tight that they're not going to be able to demand more wages. So in that way, you can pour more cold water over it, saying, yes, consumers expect more inflation, but that's not how it's going to play out.
Meanwhile, in Washington, D.C., the budget very much in focus, and that's something that a lot of people are wondering, do we get the bond vigilantes? I mean, Matt Hornbach just also pouring some cold water over it, saying, I'm sick of it. Stop coming to me with the bond vigilantes. They're not coming. We haven't seen them. They stay for about a half a minute and then they leave. But there is a feeling that maybe, Annmarie, this time is different.
Well, they've been complaining for decades, and that's Matt's point. I think also the crux of Matt's argument is when you look at this bill, the nuts and bolts of it are extension of current policy. And if you don't have that, what kind of trigger to not having growth could there be if you have American tax rates going higher, especially if people are concerned with inflation? So is this really going to be stimulative, or is it extension of current policy and a few sweeteners that the president has promised on the campaign trail?
I also think for the markets, the remarkable thing is the degree to which we keep swinging back and forth about what we care about. One day we care about trade. One day we care about the fiscal budget. I just don't know how you operate in that kind of environment, how you have any conviction in this type of environment where the narrative and what's shifting things changes from day to day.
What you do get is a lot of notes that say range bound. We're going to be trading within a range. And that's what you hear again and again. What you see in markets is a bit of softness. After the best monthly performance going back 18 months, you can see led by big tech, which have been some of the biggest winners. You can see across the board, S&P futures down 0.4%, and NASDAQ down 0.6%. The Russell actually doing better, ironically enough. What you can see in the yield space is not what you want, which is positive correlation in all the wrong ways. Yields higher, bonds lower, as people look to Washington, D.C. for the deficit. A question of who's going to buy that 30-year, maybe not PIMCO, maybe not Double Line, maybe not JP Morgan Asset Management right now, touching up against that 5% level, up about 4 basis points. Meanwhile, in the currency space, and this has been the theme and something that a lot of people are taking notice of, dollar weakness across the board. Dollar, the weakest, one of the weakest levels going back more than a month versus the euro, as people question whether this still is the type of haven spot, and also whether it just simply has gotten overvalued over the past couple of years. Coming up over the next hour, Sarah Hunt of Alpine Saxon Woods with their stocks coming off their best May since 1990. Brandon Ferris Harris of the Steel Manufacturers Association with President Trump set to hike steel and aluminum tariffs, and Aditya Bahave of Bank of America as the Fed games out its rate cut strategy amid trade uncertainty. We begin this hour with stocks lower. U.S.-China trade tensions back on the table. Sarah Hunt of Alpine Saxon Woods writing, where do we go from here is always a tough question, but under current circumstances, to echo what Danny was just saying, it is difficult to have conviction about the economic environment. The understatement of the year. Sarah joins us now. Sarah, thank you so much.
Good morning.
What is your compass at a time when, as Danny and Annmarie were talking about, there's so many different things that you have to have kind of a head on a swivel and pay attention to one thing at a time?
Well, I mean, certainly for the economic data, there's a lot of questions about whether or not the trade tensions and the tariffs have pulled forward a lot of activity. So it's hard to understand whether or not some of the good current economic data is because people have rushed out to buy things or not. I think you have to keep looking at earnings. And right now, to your point earlier, that's been a pretty good situation. The technology stocks have really continued to carry the day, and they have not been pessimistic about CapEx and spend. And I think that in all the other noise that we can see, company earnings are going to be important because that's what underpins valuation. So to the extent that that's something to look for, you have to be able to see that continuing to look good. And right now, that still looks pretty good.
It is an incredible amount that the hyperscalers, the big tech companies talked about spending. Their capital expenditures numbers were still huge. But if you remove that from American stocks, what are you left with, Sarah? Are you still as enthusiastic?
I think if you remove that, you have a problem. And that's one of the reasons that equity markets were able to pick that story back up and put it down and pick it up. To your point about switching narratives and what they care about. That AI story was a big piece of last year. And then there was a lot of questions about whether or not people didn't need so many data centers, didn't need this, didn't need that. What was everybody doing? And now the fact that that's back at the fore and people are willing to spend that money, I think is critical. Because beyond that, there are good things underlying in some other areas. But there are some places where there's a lot of uncertainty, which is why people are pulling guidance.
So is the glass half empty side of this and the glass half full side? The glass half empty is you don't have anything. What do you have? The glass half full side is, yeah, look how well they're doing. So imagine how well the others can do. We better get in over there. Which side do you land on?
You know, that's part of the problem because it keeps changing what's going to happen. And the market reacts so fast. You saw how fast it reacted to that change in tariffs on last week. And after this fantastic May, because everything was going to be fine, then all of a sudden maybe it's not going to be fine anymore. Those narratives keep flipping on a dime. And that's why you have to keep looking for those underlying, boring sounding things. Do you have cash flow? What's your balance sheet look like? All that sort of stuff, because in an uncertain environment, that's what you have to do with. And that word has become so ubiquitous that it's almost impossible not to use it. But there you are. I mean, that's what we've been living with.
I gotta say, it does feel like we're starting to get to this environment where there is some headline fatigue, where a headline comes out about some new tariff and we say, okay, Trump's probably going to back out, and we don't trade massively off of it. When it comes to those types of headlines, how do you distinguish what is signal and what's noise?
It's very difficult because part of the strategy is continuing to make a lot of noise, right? So it's very difficult to underpin and know what's happening because none of us know unless we have a window into the thought process of what's going on. So you don't know, and you have to just sort of look at a probability scenario and go, what are the odds that it's going to be so punishing that we're going to continue on that path? And then you have to say, I don't know that we're going to go down that road, even though right now it looks pretty grim. And I think that that's what April was all about, because April was building in all of the, oh my God, all the things are going to happen and they're all going to be bad. And then May was reversing that. And now we're back in the risk reward scenario where you kind of look at it and you go, okay, what's going to drive things higher? And then it's got to be the environment and earnings.
But on average, even though potentially we've seen the worst of the tariffs be lifted, there's still tariffs, minimum 10% across the board.
There are still tariffs, but you're still seeing margins not be affected too terribly yet. Margins are going to be a big part of that because even if you can grow your revenue, if your margins are collapsing because of higher costs or because of the tariff situation, that's going to be an issue for earnings. It all comes back to what is the outlook from an earnings perspective, because from the equity side of the market, that's what they care about, is that earnings growth. And if you don't get that, that's where you have trouble.
I'd love to get your thoughts on this idea, though, that even though we have seen these AI companies and tech companies do so well, Ty Kim, who wrote this book on NVIDIA, had this stat after they reported earnings saying NVIDIA would likely have been a $4 trillion company right now if Trump didn't ban the H20 chip. So while they're still doing well, how much capital is still left on the table for them just because they're being isolated out of China?
I think that is one of those difficult questions because you can see both sides of the argument, right? You can also see why you would want to have some restrictions on there, and you can see why that's hampering. But to say NVIDIA is being hampered is a bit of a stretch at this particular point because they still own most of that very high-end chip market at the minute. Doesn't mean they will forever, but they certainly do now. So I think that, yes, there are some issues there, but I think from a security and everything else standpoint, you can see why you would want to have some limitations.
So it's led to a lot of chop all of this. But Lisa was pointing out the one area that doesn't seem like it's had a lot of chop is the dollar, just this consistent weakness. And usually that's something of a ballast in a portfolio, something of a stabilizer. Are we in a moment of a structural shift where just your overall portfolio composition, the thought of what that looks like needs to change?
Well, I mean, so the dollar was trading quite strongly prior to all of this. So we're down, and we're down to levels that we've seen in the last several years. But you go back to 2021, the dollar was even lower. So if you look at that from a longer term perspective and say, there's also a switch in the currency markets about what they care about, right? It's what's wrong with the U.S. versus everything else is doing better. But can Europe really get to the point where they make some big financial commitments and start spending? And if they don't, what happens to the euro after that, right? So there is a trade-off in currencies, and it's usually not because someone's doing particularly well. It's because someone's doing particularly poorly, and everybody looks at that and says, we'll go someplace else. And I think right now the focus has been on the dollar, and it was maybe coming into that a little too strong to start with. So we'll see where we go from here. But we have come down quite considerably.
Sarah Hunt of Alpine Saxon Woods will be sticking with us as we try to make sense of what seems to be very difficult to make sense of. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Iran has rejected a UN nuclear watchdog report accusing it of nuclear violations, claiming the agency is motivated by politics. The report says Iran has expanded its stockpile of near weapons-grade uranium and failed to report nuclear material and activities at 3 locations. Iran says the findings are based on fabricated data and repeated that it's not seeking atomic weapons. Meanwhile, Karol Nawrocki has won Poland's presidential election. The nationalist candidate backed by President Trump is a conservative historian and former boxer with no previous political experience. He is expected to lead the country in a more populist path. And as Lisa said, it's M&A Monday. Sanofi has agreed to buy Blueprint Medicines for at least $9.1 billion, bringing the pharmaceutical firm closer to its goal to become an immunology powerhouse. The acquisition boosts the French drug maker's pipeline of experimental treatments, and it expects the deal to close in the third quarter. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I just want to bring this to you. We are seeing some response from the European Union to the increase in steel and aluminum tariffs. The EU saying that it is prepared to impose countermeasures if talks fail. This according to a spokesman, saying that the EU strongly regrets U.S. decisions to raise steel tariffs, and saying that the trade chief for the European Union and U.S. trade rep Jameson Greer will be meeting on Wednesday. So we'll bring to you the latest as that happens. Not a whole lot of market reaction as people try to understand what this means for the tit for tat between the U.S. and Europe. Up next, avoiding a default.
The United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
Bloomberg's Tyler Kendall joining us next. This is Bloomberg Surveillance. Coming into a new week with a bit of softness after last week's blowout gains, given the fact that we saw the best monthly gain going back 18 months, a rise of some 6%. Now we're taking back just a touch of that, although back from the earlier lows from earlier this morning, you could see NASDAQ futures down 0.5%, S&P down 0.4%. When you take a look at bonds, they're moving in the same direction, which is not what you want to see if you want that inverted correlation that had traditionally made up the 60-40 portfolio. 30-year yields up by 3 basis points, 10-year by 3 basis points as well. This, to me, has been one of the main stories. What is driving this? Is it the deficit concerns? Is it this question around inflation? Is it the move away from U.S. assets? Or is it something that is all of the above or nothing of the above? Under surveillance this morning, avoiding a default.
The United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall. The deficit this year is going to be lower than the deficit last year, and in 2 years it will be lower again. We are going to bring the deficit down slowly. So the goal is to bring it down over the next 4 years, leave the country in great shape in 2028.
Here's the latest. The Senate returning to Washington this week to begin deliberation on President Trump's big, beautiful bill. Joining us now is Bloomberg's Tyler Kendall from Washington. Tyler, what do we expect to actually get done this week?
Yeah, hey, Lisa. Well, there's a lot of different issues that the Senate ultimately has to work through. They're coming back after a recess and hearing from some of their constituents about what ends up being in this bill. Of course, the big issue is what you've been talking about, which is hiking the debt ceiling. We know that the House plan is calling for raising it from $4 trillion, but the Senate has said that they would allow even a bigger hike to $5 trillion. So we'll have to see how things like that shake out. And then they're also looking at some other priorities when we're discussing whether or not we could see some deeper spending cuts here, since we know that some moderates are pushing back on any changes when it comes to Medicaid, as well as how quickly they're going to roll back some of those clean energy tax credits under the IRA. At the end of the day, we're expecting White House officials to really start ramping up the pressure on lawmakers to ultimately come to a deal, because they are saying that they need to see this done by July 4th, because this is so pivotal to the Trump administration's ultimate economic agenda. At the end of the day, we do know, though, that the harder deadline is going to be what that X date is. Treasury Secretary Scott Bessent didn't give an updated or an exact date. Those previously said that could fall sometime in August, which perhaps would give lawmakers a little bit more buffer room. But he did go on in that interview, Lisa, to allude to the X date as a negotiating tactic, saying that they are keeping that sort of in their pocket as a way to motivate lawmakers forward on that bill.
Tyler, what are the biggest sticking points that senators have in this bill that was brought to them by the House?
What are some of the biggest sticking points? Well, definitely. We have to see how it shakes out, particularly on those spending cuts. And then also that I mentioned, but also what happens with the tax cut priorities here going forward. One of the biggest sweeteners in getting that House bill over the finish line was lifting the SALT cap to $40,000. And we know, as you well know, there aren't really any senators that are advocating for that to be ultimately included. And we have to keep in mind it needs to ultimately pass both chambers here. So could that be on the chopping block in a meaningful way? House Speaker Mike Johnson has made it clear that he has sent the message to Leader John Thune that he wants to see that ultimately in the bill. And then, Annmarie, I would also watch what ends up happening to some of the temporary tax cuts. We know that leadership has signaled that they want to see some of those made permanent, including those priorities from the White House, including no taxes on tips and overtime pay. Also, some of those business incentives, like to build factories in the U.S. Could those perhaps be made extended or more permanent? And what would that mean to these conversations about ultimately adding to deficit spending?
Tyler, before you go, have they hauled in a huge wall-to-wall Bloomberg terminal with bond yields on it, with the WB page, the World Bond page, to really just give a good backdrop to these discussions?
Not yet, but I did tell multiple lawmakers on Capitol Hill when the House was debating this that you sent me and that I was asking them if they were paying attention to the bond market or not. And I heard from multiple that they actually were. But at the end of the day, they ended up going behind this bill because they need to get the incentives ultimately through. That is one of the biggest issues here with doing this as one big, beautiful bill. There's a lot of priorities on the table, and it appeared that front-loading the tax cuts really was the message from the White House that they wanted to see done.
And maybe the 10-year yield is not one of them. Bloomberg's Tyler Kendall, thank you so much. Sarah Hunt of Alpine Saxon Woods is still with us. Of course, I am being somewhat tongue-in-cheek because Matt Hornbach was saying, stop giving that to me. Honestly, this isn't about the deficit. This is about other issues, and people have been crying about this forever. Do you agree with that, or do you think that this time really is different?
I think it goes back to the dollar still being the reserve currency and the discussions around whether or not that's capable of staying and everything else, and just not having, it's another not having an alternative. It's another Tina moment, right? Yes, you can have some bond, yes, you can see interest rates go higher a little bit, but at the same time, where else are you going to go when you need that kind of depth and liquidity besides the U.S. markets? It doesn't mean that we can't have dislocations. I just don't know that it is as big of a threat as it is in other places where the markets are smaller and it's easier for people to move things around.
Well, with this idea of what causes another major rupture, what is the canary in the coal mine? Jamie Dimon has been very vocal for some time that it will be the bond market, that its cracks are coming in the bond market, be it 6 months or 6 years from now. Is that what leads us into the next shaky period for markets? Is it the bond market that we should be concerned about?
Well, generally speaking, it's usually credit that leads you into a problem. Is it going to be government credit? That's the harder question to answer. And I think right now there are a lot of questions about all sorts of credit, but at the same time, there's still a lot of money chasing those dollars and looking for yield. So I don't know that it's as much of an immediate problem as it is a consistent thing that needs to be addressed, and whether or not it can be addressed. Scott Bessent wants to do it over a longer period of time, over a shorter period of time. It's going to need to be addressed at some point, and it's good to be discussing it. But whether or not that is what causes the dislocation, I'm not so sure.
You made a very good point earlier, which is the fact that historically speaking, the dollar's not even that low.
Well, and this is what it goes back to, there's all those horrible cliches like the worst dirty shirt in the laundry and all this sort of the best of the worst, right? So currencies are a relative game against one another. So then you have to find something that you say, okay, the prospects are much better there, therefore, or the rates are much higher there, therefore that currency is something I want to chase. You're back to the dollar and the U.S. economy being so important globally that it's difficult to separate yourself from that. On the margin, you can move money around, and you can certainly, and people have in the last 6 months or so, started shifting to other markets. But at the same time, you still have a bigger growth engine in the U.S. than you have in most of the other parts of the world. And that's difficult to ignore.
Well, even so, Sarah, let's say you're a UK investor in the U.S. You're still looking at losses for the year because of what the dollar has done if you're not hedged. In a totality of a view where the dollar is weakening and that is the trend, does it make investors more likely to sit locally? Does it just impact the flows of where dollars are going, especially in equity markets globally?
I think it definitely impacts your next choices, so the new flows as opposed to the older flows. But generally speaking, holding on to assets for a longer period of time has been what you want to do if you go back and look at even with the dislocations in equity markets. So yes, I think on the margin, again, it changes where people might put that next dollar and might put it for the next 3 to 6 months or 12 months. But from a longer term perspective, it's hard to see diversifying out of the U.S. on a permanent basis as something that's really going to end up being beneficial.
So there's a story on the Bloomberg terminal this morning. Buyers strike rocks U.S. long bond as double line PIMCO stay away. We were speaking with J.P. Morgan's Bob Michael about how the 30-year bond is a risk asset. We ask every single investor who comes on, are you buying the 30-year yield? Are you buying 30-year bonds right now? Do you think that is an attractive purchase? And what would it take for you to like that? So I ask you that. What would it take for you to actually want to load up, back up the truck for 30-year treasuries?
I'm going to be just like everybody else, sadly, and say no that right now on the 30-year.
Why? So why?
So that's a question of timing and yield right now, and I think that's the problem and that's the tension. Because if the expectation is I need a higher yield to feel more comfortable with the 30-year, then that's a problem for the rest of the yield curve, possibly, and it's a problem for yields because they need to go higher. The price movements on the longer-term bonds are much more significant to your portfolio if you're not going to hold it to maturity. If you have something where I can match that duration to the yield on the 30-year, then there's no reason not to buy it as long as you're going to hold that. It's the volatility in between, and I think that's why people look at it as a risk asset, because when the price moves, it moves. I mean, when the yield moves, it moves more price-wise.
Just quickly before we let you go, how much does this really affect the 60-40 kind of concept for you?
Well, I think you finally have gotten that 60-40 concept back, and people are happy to hold fixed income, even with some of the volatility, just because they're getting some yield. And when you don't see them move in tandem, it does work better for the portfolio. That move in tandem that correlation isn't always there, and I think people are still more comfortable holding fixed income. And again, for people, if you're holding those bonds to maturity, you can handle that volatility.
Sarah Hunt of Alpine Saxon Woods, thank you so much for being with us. Sarah Hunt there, not buying the 30-year. I got to say, Danny, this is something that we talk about all the time. People say, oh, yeah, the bond vigilantes, they're just crying. They always like to cry. But at the same time, they're not going into those long-term bonds either.
No one's buying it. And look, it might not be vigilantes causing big ruptures, but you could argue it is leading to higher yields when all things play out. And it's a problem when especially price-insensitive buyers aren't buying the long-term bond, when the Fed is loading off their balance sheet, when foreigners aren't looking at it. It just makes the asset class much more volatile.
And TD is saying that potentially as soon as August, we could have Treasury come out and say they're looking at shrinking the long end auctions, and then auctions will become a lot more important, Lisa.
Auctions have always been important, I would argue, and I will just say it's not just making American auctions great again. It is making Japanese auctions great again, because there are a slew of Japanese auctions this week that a lot of people are watching, because evidently all auctions matter. Coming up, Brandon Ferris of the Steel Manufacturers Association with President Trump set to hike steel and aluminum tariffs. That is a part of what's roiling markets. Also, the rising tensions between the U.S. and China, raising questions about whether this 90-day truce really can remain in place. This is Bloomberg Surveillance. early days yet, early hours, I should say, but maybe the sugar high from last month starting to fade just a touch as new tensions emerge between the U.S. and China percolating over the weekend, escalating this morning. We can see that sending stocks lower pretty much across the board, although we're tracing some of the earlier losses with NASDAQ futures leading the declines down 0.5%. You can see S&P futures lower by about 0.4%. 2 hours away from the cash open. Here's your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Tesla shares. Those are falling nearly 1.6% here in the pre-market. I will say overall, we are seeing weakness among the Mag 7, but also hitting Tesla is this news that new registrations for Teslas in France plunged 67% in May. They sold just over 720 vehicles in the country the entire month. That's Tesla's worst month there since 2022, while year-to-date Tesla sales in France are down nearly 50%. So the backlash against Elon Musk in Europe continuing. Next up, we have shares of Moderna. They are up nearly 3.5% here after U.S. regulators approved its new lower dose COVID-19 vaccine. And while it was approved for a narrower group of people, it is seen as a win under Health Secretary Robert F. Kennedy Jr., who we know has been a vocal vaccine critic. And last up, let's check on those steel and aluminum stocks. They are soaring here after President Trump said he will be doubling tariffs from 25 to 50% on steel and aluminum. All of this, of course, part of his push to bring manufacturing back to the U.S., and it's tied to the proposed partnership between Japan's Nippon Steel and U.S. Steel. He was in Pennsylvania touting it last Friday. So as a result, you are seeing Cleveland-Cliffs up 25% here and Century Aluminum up nearly 17%. Lisa?
Thank you so much, Yahira. We'll be talking about that a bit more in just a minute. On our radar this morning, a growing chorus of dollar skepticism. Morgan Stanley now expecting the dollar will tumble to COVID-era lows within the next year, anticipating the U.S. dollar index will fall 9% even after the losses that we've seen so far this year.
And it's troubling that they're pointing to the economy as being the reason behind this. Usually, if the U.S. economy is doing bad, everywhere else is doing worse. So you get to the other side of the U.S. dollar smile where it does well. This speaks to more of a structural shift. And this is something Terry Wiseman was talking about with me earlier, that we've had a destruction of the brand of the dollar, that all of a sudden, if you're a foreign investor, dollar assets are less attractive because of the weakness in the dollar. All of a sudden in your portfolio, the dollar isn't a ballast anymore. So it's almost this thing that tumbles, that gets worse, that snowballs because of the issues surrounding brand dollar. For every other reason, economic strength, other central banks are cutting, you'd assume that the dollar would be stronger at this point.
Well, also, Sarah Hunt brought up a great point. We're not where we are in terms of bearishness from historical perspective. So actually, maybe there is more room, to Matt's point, for the dollar to go lower. I do wonder, though, how much of this is really centered on where the administration gets when it comes to trade deals and trade negotiations, especially when the biggest economies in the world right now have a tit for tat when it comes to the trade war.
I do wonder how much of a self-fulfilling prophecy this becomes. The sort of death spiral of people who previously had bought U.S. assets unhedged because the dollar always was a strong currency and U.S. stocks always went up. And all of a sudden, you have wobbly U.S. stocks, wobbly U.S. bonds, a weaker U.S. dollar. And suddenly, how much does that cause an entire rethink of asset allocation strategies around the world? Not that that's happening in wholesale, but even on the margins, it could potentially shift the calculus.
I was going to say, every now and then you get these little things popping up that become bigger things. Japanese life insurers have been a really good example of this. In Taiwan, the movements we saw with the Taiwanese dollar last month, really good examples of this. Again, it's only on the margin at this point, but maybe that's all it takes, just this slow bleed in a weaker dollar that does signal we're at a structural difference now.
In the meantime, of course, we're watching the tensions across the world around trade. U.S.-China trade tensions returning, with China's Ministry of Commerce accusing the U.S. of violating last month's Geneva trade deal, rebuking President Trump's claim that Beijing actually breached the deal. The dust-up threatening the prospect of a potential Trump-Xi phone call this week. The phone call that again goes back to, is someone waiting in some room, waiting for the phone to ring? What exactly was happening with this phone call?
Obviously, there's a lot of discussion between Washington and Beijing every day on the more aide staff level, maybe even on the cabinet secretary level, but not when it comes to President Trump and Xi Jinping. Even though Trump always kind of says we've talked, there has not been this formal phone call that we've been waiting on. But Kevin Hassett over the weekend says, quote, it's going to have a wonderful conversation, the U.S. president, about the trade negotiations this week with President Xi. That's his expectation. But now going into it, you have the Commerce Ministry coming out and really saying the United States is not living up to the demands from Geneva. And there's been a slow drip from this administration on a number of issues with China outside of trade. AI export controls, that China has a lot of issues with, jet engine materials, also even revoking Chinese student visas. So if they sit down for this call, how much is it really going to be about trade and how much is it going to be about everything else?
And there have been a lot of reports, Wall Street Journal, some of our reporting as well, suggesting that rare earth minerals was an issue too, something that would be really critical for the auto sector. But Signum writing over the weekend that the timing for this is important, that Trump had just gotten questions as to whether he was chickening out. Trump just had a court of international trade decision go against him. So part of this is about for public consumption. It's about political appearances of standing strong and standing tough, not necessarily substantive policy changes.
Which is the reason why Signum didn't think this was a complete collapse of that truce, which was one of the more optimistic takes that I read over the weekend. President Trump, meanwhile, saying he will increase steel and aluminum tariffs to 50% starting Wednesday, adding that the move will protect American workers as Japan's Nippon Steel completes its takeover of U.S. Steel. Joining us now is Brandon Ferris of the Steel Manufacturers Association. Brandon, thank you so much for being with us. I just want to start with how the increase in steel and aluminum tariffs works hand in hand with this deal for some sort of participation with Nippon Steel taking a stake of U.S. Steel.
Absolutely. Well, thank you for having me today. And with the deal and with what President Trump announced on Friday of raising the tariffs to 50%, President Trump is responding to an industry that has suffered from surges of dirt cheap steel from foreign imports, particularly from China. And so as part of this, which was the largest investment in Pennsylvania history, these 50%, raising the tariffs to 50%, helps protect the American steel industry.
We've learned that the U.S. imports about 17% of its steel needs. This is according to Morgan Stanley. So do you think actually they really need this level of protection?
Yes. So even at 25%, and the U.S. International Trade Commission did a report on the 232 tariffs for steel. And what they found was that the price impacts were minimal, but what they really had a tremendous effect on was lowering the imports. 24% of imports were lowered when President Trump first instituted these tariffs in 2018. And so what we're still seeing is surges of steel into the U.S. China, over the last year, has dumped more than 100 million tons into the global market. That is more than we make in the U.S. in a year. So, yes, we do believe that bumping up the number to 50% is going to be very helpful for our industry.
Construction companies, I'm sure you've seen, have warned that these levies are going to be increasing the cost of critical building materials. Do you have concern about the knock-on effects, what this 50% level means for the steel industry, for things like construction as well as the auto sector?
Absolutely. Anytime a tariff or anytime a trade knob is turned, you have to look at the ramifications. And when the International Trade Commission studied the 232 tariffs, what it found was for the downstream industries, 0.2% increase on their prices. So again, small increase on prices, but a major effect on taking those imports down.
The Trump administration, though, Trump himself had opposed this deal on the campaign trail. Are you happy about the Nippon U.S. Steel deal?
We're looking forward to receiving more information. Again, what we look at is right now it is the #1 deal that has ever been announced in Pennsylvania. One of our other members, Nucor Steel, had just recently announced the largest investment in West Virginia history. So 2 out of 50 states, the largest investment in their history is steel. And so we like where this trend is heading.
Brandon, you mentioned the dumping of steel in U.S. markets coming from China. But let's be clear, this tariff will affect much more than China. It is a sledgehammer, and you've seen complaints, for example, from the EU, from the UK. Is this the right method to take for what is a very serious problem? Should there have been something more surgical coming from the administration?
We do believe that the 232 steel tariffs are surgical. And with this, yes, we do believe that it will help our industry. And the problem is not just China, it's global overcapacity. Lots of countries use cheap Chinese steel to replace their own and then send theirs onto the global market. And so this will help solve that issue.
So another concern, which again, the most recent moves, I'm sure you're hoping to concern, is something of just job stability and job security and any guarantees that the administration and many people hope that Nippon Steel will guarantee. Brandon, how far can those guarantees go when it is an industry that is facing a lot of changes, that is facing changes when it comes to technology that change the workforce? How long can job security be guaranteed?
I can't speak for U.S. Steel, but what I can say for all of our members is that they have a more full order book than they've had in years. And what we're hearing is that we're hearing growth. Nearly every one of our members has announced growth, and this means more jobs, this means more revenue, this means better benefits for the economy. And so right now, what we're looking at, and what we've looked at since President Trump first instituted these tariffs in 2018, is a changed industry and a changed for the better. And that's what we're looking at when President Trump has recently made this change to 50% as well.
Brandon, are you worried about the U.S. losing customers if the U.S. angers essentially Canada and the European Union as some of its biggest exporters, or the people who actually buy some of this steel and aluminum, maybe sending them to look elsewhere if suddenly prices are that much more expensive?
What we can say is that most of the steel produced in the U.S. is used in the U.S. We do have some trade with Canada. We do have some trade with Mexico. And I know that there are going to be negotiations this year talking about that. But as far as protecting the domestic steel industry, which is vital for economic security, energy security, national security, we believe that moving the tariffs up to 50% was a very good move.
Brandon Ferris of the Steel Manufacturers Association, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Tensions are flaring between Russia and Ukraine. A Ukrainian drone attack destroyed more than 40 planes deep in Russia's territory, while Russia launched a drone and missile attack against Kyiv, killing at least 12 people. The attacks come as both countries prepare to send delegations to Turkey for a second round of peace talks today. Meanwhile, General Electric is passing on additional charges caused by President Trump's tariffs. The world's largest aircraft engine maker has about $500 million in residual cost challenges stemming from those tariffs. GE CEO Larry Culp is advocating for a return to a duty-free regime, making direct appeals to Trump and calling for the industry to speak with a unified voice. And Mission Impossible: The Final Reckoning is back on top in China. It posted the biggest opening for a U.S. film in the country this year, defying trade and geopolitical tensions between Washington and Beijing. Paramount Global's 8th installment in the action franchise earned more than $25 million in China during the opening weekend. Tom Cruise has worldwide appeal. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We'll move over. Tim Cook is the world's diplomat. Now it's Tom Cruise.
It's our cultural output, you know.
Maybe he's the one that could set up the shishing.
Yeah, there you go. He'll come in on a plane being like, let's go. Yeah, meanwhile, up next, mapping the rate cut path.
Assuming that the effective tariff rate settles close to my lower tariff scenario, I would be supporting what I called good news rate cuts later this year.
Maybe trying out for something. Aditya Bahave of Bank of America joins us coming up next. This is Bloomberg Surveillance. Stocks coming off some of the earlier highs that we saw last month as people take a look at some of the tensions that are brewing between the U.S. and China, between the U.S. and Europe, between Republicans in Congress, as senators take up the deficit concerns with respect to the budget bill. We're looking at stocks that are off, although you can see bonds off too. And this is the correlation that a lot of people are getting concerned about. Although it's off some of the earlier lows, you could see yields rising across the board, the most at the long end of the yield curve with 30-year yields at 4.96%, up 3 basis points. Under surveillance this morning, mapping the rate cut path.
Assuming that the effective tariff rate settles close to my lower tariff scenario, that underlying inflation continues to make progress to our 2% goal, and that the labor market remains solid, I would be supporting what I called good news rate cuts later this year.
You heard that here first. Here's the latest. Federal Reserve Governor Christopher Waller sharing his expectations for interest rate cuts later this year, assuming inflation expectations remain anchored. Aditya Bahave of Bank of America writing, we now forecast 100 basis points of cuts next year. With low conviction, we pencil these cuts in for the second half of 2026. Aditya joins us now. And Aditya, thank you for that, because we're all humbly having low conviction about absolutely everything. So join the club. We're joining the club. I am curious what you make of some of those Chris Waller comments, where he seems to talk about good news rate cuts at a time when so many other Fed officials are saying we have no clue.
Thank you for having me. I think we have no clue is probably a more accurate representation of where we stand. The challenge here is that we had fairly favorable base effects on inflation for the first 4 months of the year, and so it isn't hugely surprising that we got down to about 2.5% on the core. The problem is over the next 8 months, the base effects are much less favorable, and so going down further is very unlikely, and in fact, it's more likely that as the tariffs set in, inflation will increase on a year-over-year basis.
Well, Chris Waller's argument in that was that you could look through that because we don't have the same tightness in the labor market, and the ability for employees to go to their employer and say, hey, inflation's going up, pay me more, is limited because they just want to hold on to their jobs at this point. Is that a fair characterization of where we are?
Okay, but if inflation's above target and you aren't sure whether you should look through the shock or not, and at the same time the labor market's holding up, why do you need to cut at all?
Yeah, fair enough.
So we don't think they're cutting this year, just to be clear.
So they're not cutting this year, but also another input into this, and this is something Michael Gapin at Morgan Stanley has talked about, this idea that we're going to have low immigration. And low immigration also means that the labor market's going to stay tight as employment growth slows. How much is that going to impact the outlook as this year progresses?
That's a more difficult one. I think it'll be very differentiated sector by sector. You're going to be seeing some sectors that are more dependent on immigration that could see wage pressures, such as construction, leisure and hospitality, agriculture. But in aggregate, if you're basically shrinking the population, you're reducing supply and demand. So it could also end up being a wash.
You said that if the labor market is holding up and inflation goes higher, why should the Fed do anything? Well, if inflation is going higher, shouldn't they be hiking?
Right, so that's a question that comes up every now and then. I think they're some ways away from hiking just because policy rates are already quite elevated, so they'll feel like they have some buffer. And again, they'd rather be late than wrong. This is a point that we've made, and I think it holds in both directions.
So you think this potentially will happen, even though you have a little bit of grain of salt on there, the second half of 2026. So do you think we'll have certainty on trade policy out of Washington by the second half of 2026?
Right. So the way we're thinking about the second half of 2026 is that by that point, the tariff-driven inflation will start to roll off the year-over-year rate because of base effects. So with inflation below 3%, maybe a slightly looser labor market and different Fed leadership, you might end up getting rate cuts.
You said different Fed leadership. This is the question that we all really want to ask. Is Chris Waller just trying to get the job?
I'll let you decide that.
Okay, well, it seems like a lot of people would say yes. Is this the mainstream thought, or could this be the mainstream thought of the Federal Reserve? Do you think that this is the person to watch to see the direction for the Federal Reserve in 2026, Chris Waller?
So he seems to be, for now at least, a bit of an outlier on the committee. I think what you're hearing from Chair Powell and then others like Hammack and Williams is that the Fed is very patient right now. They just have no idea. Honestly, if you told me that the Fed should be preemptive, I would ask you, what is the Fed even trying to preempt right now? There's risks in both directions to trade policy. There's risks in both directions to fiscal policy. Let's just wait and see how it plays out. So Waller seems to have a pretty optimistic outlook that we're going to be able to do good news rate cuts by the end of this year, and that just seems a little bit too soon for us.
I'm sympathetic with this. The question, though, of wait and see for a data-dependent Fed really raises a question of what are you waiting for? Because the data is so incredibly messy, not only from a backward-looking, forward-looking, medium-working kind of point of view, but also just from a data collection point of view. You've had a real question about a lowering of response rates to some of the non-farm payrolls responses. Sentiment surveys are basically throw a dart at a dartboard. What do you do with the integrity of some of the data that we're getting?
So the good news about the payroll surveys is that at least by the time you get to the third reading, the response rate is pretty decent.
Yeah, when do you get that? 2030?
No, you get that by 2 months later, right?
Okay, but the point being.
Well, and then you have data that's unreliable. You have a Fed that's not moving. Aditya, the Fed is not in the driver's seat. It is a political economy, and you can even see it in what's happening with the currency market. Interest rate differentials are not making a difference. Is it a problem that the Fed is very passive right now, that they are very reactive? Is it a problem, especially if this economy heads in a worse direction?
I wouldn't characterize the Fed as passive. I think they've actually been pretty clear about their stance. They've pushed back against market pricing of rate cuts. They've made it very clear that they're concerned about inflation to a degree that was more than perhaps I would have expected. I mean, did you look at the minutes last week? It was really striking for me. They had this, when they were the discussion around balance of risks, they basically gave you this laundry list of concerns about why inflation might end up being sticky, and then just a sentence or two in the other direction, right, which was probably written by Chris Waller.
What is the danger? Just lay it out for us. If the FOMC starts to coalesce a Chris Waller type of policy outlook, what is the scenario? Why is that the wrong decision?
I think it's concerning in the sense that we just don't know what policy is going to get implemented first, and then second, we don't know how it's going to affect the economy. Right? Basically, what we're looking at is a negative supply shock from the tariffs being offset by potentially a positive demand shock from fiscal policy. That can give you the offset that you're looking for on the fiscal side. It can give you the offset that you're looking for on the output side. The problem is it can be additive on inflation, right? That's why they have to be very careful about the risks around inflation. And the other concern would be just that companies could raise their prices a little bit every year if they're concerned about losing market share, right? So you could get less inflation in the short run, but stickier inflation over time.
Just to give us a compass for how to look at the week ahead, what data point do you think is going to be most relevant? The JOLTS, the job openings, the non-farm payrolls report on Friday, or the Beige Book with all those quotes from specific regions telling you, I feel good, I feel terrible, I feel inflation, I feel layoffs?
I think it's the unemployment rate. You really want to watch the unemployment rate. I mean, typically the establishment survey is more reliable than the household survey, but as you mentioned earlier, we're in an environment where there's some movement around immigration policy, and that can affect labor supply. That can affect non-farm payrolls. So the unemployment rate, as long as that stays 4.2% or below, I think the Fed's going to be very comfortable sitting where they are.
Aditya Bahave of Bank of America, thank you so much. Great to see you. Always insightful. They might be comfortable staying where they are, but Annmarie, I bet someone in the White House is not.
They're definitely not. We saw a lot of showboating from this president on wanting the Fed to cut interest rates, saying they're too high, calling Jay Powell way too late. Aditya's point on unemployment rates is also interesting, though. Bloomberg Intelligence is saying that they actually see it tick higher, 4.3%. You have to wonder, what's the line in the sand for the Fed when they see an unemployment rate, if it does tick higher?
It raises this question, though, and Denny, you say, is this a passive Fed? And it's a question of how are you active at a moment where there are two-sided risks, and it's so hard to track one way or another with policy that's whack-a-mole.
Again, I think it's so important to look at the dollar in this context. Everything is telling you that the dollar should be stronger. The fact that you have a Bank of Canada and an ECB that are about to cut rates, the fact that the data has been holding up, that there still is some inflationary fear, and yet the dollar is weaker. It shows you that the Fed is not in the driver's seat, at least when it comes to currency. You can argue about their policy as a whole, but at least when it comes to the dollar, they are not in the driver's seat.
And it shows the huge dispersion on Wall Street, because you've got Bank of America saying no rate cuts this year, and you have Matt Hornbach of Morgan Stanley coming out with a pretty aggressive rate cutting schedule for next year, which they think does support bonds. Coming up next hour, Victoria Fernandez of Crossmark, Sadie Wudlitz of SW Retail Advisors, Stephen Stanley of Santander, and Winnie Caesar of Credit Sites as we count you down to the trading day. It starts in about, an hour and a half, and we will be here. This is Bloomberg Surveillance.
The magnitude and the severity of the trade restrictions are in doubt.
Many companies are on pause. They're waiting to see what's going to happen.
One thing that we have seen has been a willingness by the administration to extend deadlines related to tariffs.
What can happen from a policy standpoint can change any minute.
Data, the administration, trade is so volatile. But at this point, I think that we've really seen the worst case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back. With 90 minutes until the start of the trading day, coming off the biggest monthly May return for the S&P 500 since 1990. Sounds nice and dramatic, with a bit of a reality check this morning. Tensions between China and the U.S. rising back up, tempering the sugar high from last month's trade optimism. And Danny, earnings beats.
Yeah, a lot of earnings beats, and it feels like it's given us the confidence to say, okay, there's a lot of headline policy volatility. Let's ignore it. It seems like we're in this new regime where we assume that no policy, be it from the Fed or be it from the governor, will be followed through if it risks upsetting the market. You continue to see this market that climbs the wall of worry, but it's a narrative, and we have seen very acutely this year that narratives quickly change.
Which raises a question of what's reality and what's simply a narrative that's going to change by tomorrow. And that's why I ask you, Annmarie, how much we can really take away from the war of words that we see on the part of China as well as the U.S. saying there have been violations for this trade truce that goes into effect.
Well, I think you'd see an optimistic market if President Trump was to get on a call with Xi Jinping, which Kevin Hassett said he's waiting for this, quote, wonderful call that he expects to happen this week. I think right now what you see is both of these economies going into potential call with maximalist demands. But really, it comes down to the crux, I think, honestly, in AI and semiconductors. This administration has been very aggressive, not allowing some of these high advanced chips to go into China. At the same time, that is something China is not going to agree upon any trade agreement unless they can get some of that access.
As Kate Kalugowitz, a former trade rep for the first Trump administration, said, it really comes down to what is the ultimate goal, not just necessarily what are the deadlines that are going to be coming up at any given time. And this really comes not just with respect to trade, but also with respect to the budget. And I have to say how much, you said this earlier, Danny, which I thought was really astute, this point about what are people focusing on any given day? It changes your head on a swivel, whether it's trade discussions, whether it's earnings, or whether it's the budget and concerns about deficits.
Because you don't have any clarity on it. That's part of the problem. What do you sink your teeth into when it is changing every day, when the headlines are always changing? And you also can't sink it into the data. To your point, the data is extremely confusing. Maybe one area you can look at, which I think has been really interesting, is shipment volumes. Dropping from basically everywhere in the world to the U.S., despite the fact we've gotten pauses. We expected all of a sudden everyone would be shipping things in to get ahead of when that 30% tariff comes away from China. It hasn't happened. And that does speak to maybe corporate earnings will get worse. Maybe the one thing that was better is going to deteriorate. And maybe it's a bad signal for inflation as well.
Yeah, the new data, shipping and also electricity demand and other ways of measuring some of what seems to be increasingly unmeasurable. What we're seeing in markets is a bit of softness to start the month, to start the week as people retrace some of the gains that we saw last month. The S&P lower by about 0.4%, NASDAQ down by about 0.5%. The Russell 2000 doing a bit better, about 0.2%. If you could see in the bond markets, what's getting some people worried is this positive correlation continuing, with yields continuing to grind higher, particularly on the long end, and continuing to grind higher throughout the morning. 30-year yields, that risk asset, 4.97%, clawing up toward that 5% level, up now 4 basis points. And this comes with that dollar weakness that we have continued to see throughout the month, throughout the year. The dollar weakening versus the euro the strongest versus the dollar going back to late April, as people take a look at the ramifications of some of these trade negotiations. Coming up this hour, Victoria Fernandez of Crossmark, as trade tensions weigh on markets, Stacey Widlitz of SW Retail Advisors on the state of the consumer, and Stephen Stanley of Santander, counting down to the May payrolls report that we're not sure what to do with just yet. We begin this hour with stocks lower following their best month since November of 2023. Victoria Fernandez of Crossmark writing, uncertainty remains even if economic data and technicals show the markets holding their own for now. We see additional choppiness in the coming quarters. Victoria joins us now for more. Victoria, join the club. Everyone's seeing choppiness because it's very hard to get a sense of what kind of direction to go in. I want to start with something that Danny was talking about earlier, which is that it's very hard to know which thing to focus on at any given time. Have we gone past earnings, and so now the focus just shifts squarely to trade, or does it shift to the deficit, or does it shift to something else completely?
Yeah, I wish I could give you a good answer on that, Lisa, but I'm just not really sure where the focus is going to be. As you guys mentioned earlier, it changes on a daily basis. So we're mostly through earnings, but there still are some good retail earnings that are going to be coming out this week. We've got some tech earnings coming out, but I think we're basically through that component. It's going to be, do expectations of earnings continue to get moved lower for the next couple of quarters? That's going to be the key component as it relates to earnings. And we've seen that happen. So that's going to be of concern. But obviously, it's headlines that are going to be driving so much of this. The consumer is what people are watching. Credit spreads is what we're watching. Corporate profits is what we're watching. Those are all important, and they're all going to move on a daily basis depending on what it's hearing from trade and from the tax bill. So I think you have to take it all in stride, through a lens, however, of not being sure how much you can rely on the data, because how much of it is just due to the pull forward that we saw in March. That's another element you have to bake into your observations.
Which is one reason, Victoria, that a lot of people got a lot of confidence from earnings over the past couple of weeks. They came in significantly better than expected. Julian Emmanuel calling it a boom in earnings and the consequence in the response in markets. That's real. You are seeing those profits. You are seeing companies that are still able to reaffirm some of their guidance. Does that give you confidence to be a little bit more bullish in risk assets than you were previously?
I think it gives us confidence in knowing that we will come through the choppiness that we're talking about over the next couple of quarters through all of the trade headlines. We will come through that, hopefully with stronger economic elements on the other side of that. One of the most important things I think we're seeing out of earnings is that we can continue to have that CapEx number because profits remain strong. So you had revenues up, 6% or so this last quarter. When you look at CapEx, you've got a 2.5 times multiplier in regards to every dollar spent, and that's 13% of our GDP. So I think CapEx could be an element that continues to boost the economy, even with the churning that we anticipate.
Victoria, how surprising is that figure? Just because when all of the trade headlines started to kick off, the narrative was, and let's be honest, still is, that businesses are paralyzed by it, that they're not committing capital. They don't want to put things to work because they just don't know what type of environment they're going to be operating in. So are the CapEx figures we got and the expectations for them, not trying to be cute here, but are they real?
You know, I would have thought if you'd asked me that maybe 6 weeks ago, I would have been very concerned in regards to the earnings that were coming, to the guidance that we would get as it relates to CapEx, because of exactly the elements you said, because of the uncertainty and not knowing what to do going forward. But it seems like a lot of the businesses over this last earnings season have really kind of reiterated some of those CapEx spends. Obviously, some has been pulled back. But overall, we've still had some strength there. So I think if that continues, which it seems like it might if things stay status quo or slowly begin to improve on the tariff front and on the tax bill front, then I think you have the opportunity to see the markets move higher once we get through the headlines.
So American companies still want to spend, still want capital expenditures. Victoria, in Europe, it was much weaker what we got from their earnings in terms of capital expenditures. We are looking at an S&P that's up just 0.5% so far from the year. In Europe, stocks are up 7.5%. Looking at the company earnings, does that suggest that that balance needs to shift back to the U.S., that European outperformance maybe has gone as far as it can?
I think there's a few elements that kind of drive that story of shifting maybe back to the U.S. We had kind of broadened out some of our exposure to include Europe earlier in the year. But you had a lot of catalysts that drove that. You had the change to the debt. You had an increase in defense spending, and we saw the European markets really respond. And at that point, we thought it was time to take some money off the table and move back. And now you have increased concerns around inflation. We're seeing increased concerns, like you said, around corporate profits and what that means for CapEx. So I do think you could trim those positions, move them back into the U.S., into some of the sectors where you're seeing the momentum play. That's the most important factor right now in the market, is the momentum factor. Beta has kind of hit a little bit of a peak. And so I think that flows into this story of trimming those winners and maybe moving back into some of the areas that have better potential going forward.
How much of the international story will be told by what happens with some of the budget negotiations in Washington, D.C. right now?
Well, I think it all ties into what we're seeing as it relates to the dollar and into currencies, which you guys have been talking about this morning. So we've seen the dollar come down in concern around the deficit. You see that play out on a global basis. So you want to look at some of those countries that maybe have current accounts on the positive side of that should be supportive of their currencies versus the U.S. But obviously, it's a global trade economy right now. And so anything that happens on these fronts is going to affect everywhere. And we've seen it in yields rising. We talked about U.S. yields rising this morning. We've seen it in gilts and we've seen it in boons as well.
But how much of what's going on in Washington, D.C. when it comes to the fiscal package actually a headwind, or is it a tailwind? Because the fact of the matter is, this is just current policy as the crux of this bill.
Yeah, Annmarie, it's interesting because we always thought that from the very beginning of this new administration, we didn't think it was just like tariffs on their own. It was always kind of a more holistic plan of tariffs and deregulation and lower taxes and improving some of these elements for businesses. And so I think you have to look at what's going on in Washington through that lens and say, how does this help counteract some of the more downside elements that we're seeing from tariffs? It's a very important component. Congress is relying on some of the tariff revenue to offset some of the deficit costs. That's how they're able to go in and say that this is not going to add to the deficit. So it's something that we have to watch. It's all tied together, and hopefully we come out of this with some benefits from both sides.
Victoria Fernandez of Crossmark, thank you so much for being with us. Have a great week ahead, and we'll see you soon. Right now in markets, a little softer as people try to figure out where to focus next. Let's focus next on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Delta Airlines CEO Ed Bastian expects demand to tick up a bit in the second half following weakness in bookings in the U.S. market. The company is due to report earnings in early July and is navigating challenges such as tariffs and consumer hesitance. But Bastian believes the uncertainty will pass and a new stability will emerge. Meanwhile, raging fires in Western Canada forced thousands of people to evacuate from their homes. Meanwhile, oil producers in the region have evacuated workers, slowed or halted production, and have planned delays due to the intense fires. And former Fed Vice Chair Stanley Fischer has died. Fischer served as Vice Chairman of the Fed from 2014 to 2017, following 8 years as governor of the Bank of Israel. He mentored a generation of policymakers at MIT, including Ben Bernanke, Mario Draghi, and Kazuo Ueda. Fischer was 81. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, a giant in his field who is remembered by many. Up next, the morning calls, plus Stacey Widlitz of SW Retail Advisors on the state of the consumer. That's coming up next. This is Bloomberg Surveillance. Clawing back some of the losses from earlier this morning, still a softer tone as people take a look at what's going on with the tit for tat between the U.S. and China, whether this truce could actually continue. You do see the NASDAQ leading the declines lower, 0.5 of a decline this morning. The Russell 2000 down actually a lot less, which is interesting given how much that had been the leader in terms of declines over the past few months. Time now for the morning calls. First up, Bank of America upgrading Boeing to buy, saying its aircrafts are the Trump administration's favorite trade deal tool. Next up, JP Morgan raising its price target on TJX to $145, the firm expecting a, quote, trifecta of profit and loss upside drivers. And finally, Wells Fargo raising its price target on Dollar Tree to $105, saying it expects a strong first quarter earnings report with accelerating share gain. Sticking with retail, Stacey Widlitz of SW Retail Advisors writing, consumers are in full-on value mode as inflation continues to be top of mind. Stacey joins us now. Stacey, thank you so much for being with us. We have been talking about how there is this end to the earnings season, but there are a couple of retailers still to come, including Dollar Tree and Dollar General. I'm just wondering what you're looking for in all of the retail earnings and what you've seen already that gives you an indication of what consumers are actually doing with the uncertainty that they're feeling and how they're putting it into action.
We've seen this, as you just said, this hunt for value. And you've seen that in the winners, whether it's Costco or Walmart or TJX you just talked about, traffic up, share gains. So that's where the consumer is going as the inflation headlines continue to hit them and as tariff fears continue to hit them. I would also say that we've never seen a bigger gap between winners and losers when it comes to brands. And you've seen turnaround stories like Urban Outfitters that have been huge winners this season, and the consumer is absolutely shopping there. And then you've seen others like American Eagle that had huge missteps and took inventory write-downs. So the consumer's still out there, but they're definitely looking for the best deals. They're definitely worried about price increases. And in some cases, we're already seeing those come down the pipeline.
The inventory picture has been fascinating, Stacey. To your point, American Eagle, that write-down, also saying that they've been giving discounts. How difficult is this environment for retailers to figure out how much they need to be stocking up, especially as what tariffs ultimately look like is still unknown?
It is hugely complicated to figure this out because if you think about it, as tariff fears were coming in, retailers were saying, okay, we should front load. Let's get stuff in before that happens so we can get our, maintain our margins at least for another few months before holiday. But then, of course, if you bring it in and it doesn't sell or you have a fashion miss like American Eagle, you have a write-down. You have too much inventory. And it's interesting because this really came at a time when inventories had been so clean for about 18 months. We were really at a point where you guys might have noticed when you're online looking for deals, there really haven't been as many deals over the last year and a half. So you've seen some spots, whether it's the Abercrombie brand, they've been promoting more to clear inventory when their brands really aren't hitting on all cylinders.
Is it your assumption then that it's going to be margin difficulty for the entirety of the industry, or is it just the likes of those of American Eagle that are having some issues with their strategy?
Well, I think again, there are definitely some winners that are still doing very well. But take Gap for example. They actually came out and said, our bottom line is going to be hurt by $100 million if the tariffs roll out the way we expect. So everybody's going to be under pressure. But you're seeing certain brands raise prices to offset it. And let's be honest, every year retailers do raise prices. You forget during COVID, prices went up significantly, whether it was Tapestry, that's Coach, or the luxury brands. And those guys are not promoting Ralph Lauren. They've gotten away with these price increases. They have not had to promote, and the consumer's still buying. So I think it's about what your product is. If it's in demand, you absolutely can get away with it and maintain your margins.
Stacey, over the weekend, the Treasury Secretary pushed back on this idea of what Walmart's saying and Best Buy saying, and he said, well, look at what Home Depot and Amazon are saying. Is it a tale of two different tariff stories depending on what retailer you're at?
It is, and it also depends on where your stock is coming from. Are you heavy on China? Are you heavier Vietnam coming in? Are you local? A company like Bath and Body Works, they're local. They produce locally in the United States, so they don't have to deal with the majority of the chaos that's going on. So that's certainly a big swing factor.
The Treasury Secretary also talked about how he was reading the South China Morning Post, and they said that China, those factories, are eating 65% of the tariffs, these Chinese producers. Is that accurate?
Well, what really happens, as we all know, is the consumer typically eats it. Or to some extent, the companies that have the power, like a Walmart, can certainly go back to their vendors and say, here are the terms. You're going to share the pain with us so that we don't have to push the whole thing onto consumers. So it's a little price increase to the consumer. It's pushing back on vendors. But the majority of it we will see, on this side, certainly.
Stacey, are there going to be no back to school sales? I've got to be honest, we've been kind of debating this idea of sales because we've all kind of seen anecdotal sales and we're just wondering whether certain places can get sales and other places don't, whether there's certain types of products that are just not going to go on sales or whether your pencils are going to cost $5 each. I mean, do you have a sense of, are there particular areas that are just really becoming immune to any kind of cost cuts whatsoever because the margins are just so slim it's going to be impossible?
Absolutely. And I think, if you see any promotions back to school, it's going to be in those fashion names that perhaps don't hit it right with the consumer. And that's where your opportunities will be. Certainly in consumer electronics, you're not going to see any deals this year going into holiday, or fewer deals. And of course, in footwear, we've seen a lot of volatility with Nike not doing well. But still, if you're out there and you're looking at apparel in the athletic space, the percentage of apparel on discount year over year, which we track at Nike and others, it's still way up. So there's still some deals to be had in the athletic space. But for basics, I think, like the last year, you're going to see slim pickings on the big discount side.
For those companies that don't hit it right, as you say, Stacey, what are they getting wrong? I mean, you look at a Gap who's tried to be really cool. They've done really interesting stuff, putting some of their fashion on red carpets. American Eagle, they've been trying to change. What are they getting wrong at this point?
So I think if you look at the turnarounds in terms of Urban Outfitters, which comped positive along with their Anthropologie brand that's been doing so well, they've been speaking to a younger customer. They've gotten their fashion correct. You look at a brand like Hollister that's been comping up 20%, again, like major turnaround in who they're speaking to, what their value fashion offering is. So they've been winning massive amounts of share. And at the same time, those ones have not been promoting. They're as full price selling. You're looking at the Gap. Their denim campaigns have just been a home run. Same thing at Old Navy. We've seen less promotions and less often 50% off sales all the time from those retailers. So it really starts with the product, and then everything else falls into line in terms of the margins.
Stacey Widlitz of SW Retail Advisors, thank you so much for being with us. The point here that we're trying to get to is how much resilience does a consumer have, right? How much can a consumer really absorb some of these price increases? How resilient are they to some of the uncertainty that they feel, that they express in these surveys that people seem to be discounting? And how much can we use that as some sort of forward indicator as we have in the past? And Danny, I think that that's what people are having a hard time wrapping their head around, because that's a confusing story too.
It is. I also thought it was really interesting, the airlines today, they were at IATA talking to Bloomberg's Guy Johnson, saying demand is starting to come back. We are seeing more people travel. And they were kind of the canary in the coal mine. The first one to be saying that the consumer isn't spending more, they're pulling back on flights. They're starting to see it reemerge.
Well, we heard that last week from United. They're saying that they're seeing all these flights. People are really starting to come back in the travel space. One key thing when it comes to travel and these airlines is their biggest expense is fuel. And actually, airline fuel, jet fuel, has actually been coming down.
Which is the reason why they've been able to do this and maintain their margins. A real question going forward about what that demand will be. How much is domestic? How much is international at a time when potentially some of the international tourists are not coming back to the United States? Coming up, Stephen Stanley of Santander counting down to the May payrolls report as we try to understand how to even begin to look at the data that is coming up. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. We're looking at markets a little bit softer, about an hour away from the opening bell, as we take a look at some of the rising trade tensions between U.S. and China. A real question here going forward about whether this actually does imperil the truce. NASDAQ futures leading the way lower, 0.6%. In the bond market, you could see yields just creeping higher. Again, that positive correlation, and now near the session highs on 30-year bond yields of 4.97% up, almost 5 basis points at one point. And in the currency market, more of the same, and that is dollar weakness, euro strength. The euro touching near its highest levels going back to the end of April. 1 hour away from the cash open, here is your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. It's an M&A Monday, and this time it's in the pharma space. We are seeing Blueprint Medicines up 26.5% after Sanofi agreed to buy the U.S. biotech for $129 a share, all in cash. That represents a 27% premium to Blueprint's closing price on Friday. And this is a hefty price in a market where pharma M&A has been cautious. We haven't seen big pharma deals like this one all year. Lisa. Next up, we have the automakers. They are weaker this morning. Stellantis down 2.6%, while General Motors and Ford also weaker after President Trump pledged to double U.S. steel and aluminum tariffs to 50%. Bernstein analysts are saying the hike could raise car production costs by over $7,000 per vehicle, since metals, of course, make up a big chunk of auto manufacturing costs. And last up, we have sports betting companies DraftKings and Flutter, both lower after Illinois proposed an increase to its sports betting tax. Under this, operators would pay 25 cents per wager starting July 1st. But once they accept more than 20 million wagers, that tax will increase to 50 cents. And given both companies typically draw in about 150 million wagers a year, analysts say that bigger charge is likely to be triggered pretty quickly. Lisa?
Thank you so much, Yahaira. Nothing like a buzzkill of an extra tax on your sports gamble. A busy week of economic data coming up ahead, culminating on Friday with that May non-farm payrolls report. Michael McKee, Bloomberg economics and policy correspondent, joins us now for more. Mike, what are you watching for most closely?
Well, obviously, we're going to watch jobs. This is the first week of the month, and we get some of the biggest data points of the month during this week. So a lot going on, a lot for the markets to watch, a lot for the Fed to watch, although isn't really going to make much difference given that we still have no idea what's going to happen with tariffs. But as I mentioned, Friday's the big one with the jobs report. But today, we do get the ISM manufacturing numbers, and those will be of great interest to a lot of people looking at the new orders complex and whether or not export orders have cratered. And of course, we want to see what's happening with employment and with prices. Prices shot up in the last ISM number. Factory orders, an update on durable goods and non-durable goods. Jolts tomorrow. Jolt's much less important than it has been. And ADP, everybody trades on it. Lisa loves it. But it's not something that's going to get a lot of people all excited, I don't think. Trade balance on Thursday, we'll get a better look at what happened with the collapse in the trade balance, trade deficit that we saw last week. Jobless claims, everybody watching for first signs of problems. There are a few last words coming up this week from Fed officials. Not sure that they will make a whole lot of difference, given that everybody on the Fed continuously says, we don't know. But you've got Logan Goolsbee. Jay Powell speaking today, but it's really just a welcoming address to a conference at the Fed. Not going to be any monetary policy to it, as we understand it. Goolsbee, Cook, Logan on Tuesday. And then Saturday is, I think, when Steve Stanley and everybody else is going to be happy. Me too. We go into the Fed blackout period, and we won't have them to worry about for a couple of weeks.
Mike, thanks so much. And I will just say, everyone says they don't care about ADP, and then it comes out and it fits with a narrative and everyone trades on it. So we might see more of the same in just a minute. Stephen Stanley might be happy not to hear more Fed speak. We can ask him. He's sitting right here. Stephen Stanley of Santander joining us for the next segment. I'm just curious, with all of that data, Peter Scheer's words stand out to me, and I keep thinking about this over the weekend, where he wrote, sentiment surveys are on the cusp of shifting from confusing to irrelevant. He talks about, okay, that's sentiment surveys. Even the establishment surveys, responses have come down so much as to render them also questionable. How reliable is the data we're even looking at?
Well, I mean, it's the best we got. So we've got to go with what we have. I think, the macro data is still pretty good in general. And I think the gap between the what people call the soft data and the hard data has been pretty dramatic over the last few months. But for example, I'm not surprised that we're seeing a big difference between consumer confidence and consumer spending. The correlation between those two has never been that great. So I think we're at a point now where there was some really bad soft data earlier in the year on the immediate aftermath of the tariff announcements, and we haven't really seen the follow through in the hard data. So we're at a critical juncture, right? The data for April were surprisingly unaffected by the tariffs, and now we're turning to the May data, and I think that's going to be critical.
So you think actually this is going to be really important data that does give us a tell of exactly what the read-through is to both the jobs market as well as just generally to sentiment. And we're not just talking about non-farm payrolls, but also the beige book and some other kind of tertiary indicators.
Well, I mean, if you look at the April data, right, employment number was fine, retail sales were fine, even the CPI was not anything different than normal, right? So there wasn't a tangible impact from the tariffs on the data in April, which is a little bit surprising, although, in retrospect, we hear anecdotally that retailers were holding the line as long as they could. But, for example, Walmart said earlier in May that they weren't going to be able to hold the line much longer, right? So I would expect you're going to start to see some impact in May, and then the peak impact would probably come in June and July. And then what the Fed is looking for is then, going over the other side again and hopefully getting back to normal. We'll see whether that happens, particularly for inflation.
There have been those making the argument that even putting beside the trade impact, there's already weakness. Neil Dutta has been making this argument. David Rosenberg has been making this argument that if you look at the lack of hiring and low jobs openings, all of that paints a picture of labor demand that looks something akin to 2020 levels. Are they right? Is a fine and benign headline level of employment masking over what's some real cracks in the labor market?
Yeah, I mean, I think what we're seeing is just a diminishing churn in the labor market, right? Job openings have been falling steadily since they peaked, 3 years ago now, but layoffs have also been very low. And I think you would expect in a period of uncertainty that employers would be even more cautious in terms of hiring. But the big shoe that hasn't yet dropped is this increase in layoffs. So, very closely watching various indicators of layoffs, and the timeliest one is obviously the weekly jobless claims numbers.
What does that environment mean for employees' ability to turn to their employer and say, I'm worried about inflation, you need to pay me more?
It's not a great time. If you're worried about potentially being laid off, you're not as likely to be bold to go into the office and demand a raise, right? So I think that uncertainty affects the economy in a variety of ways, and that's definitely one, is that it impinges on people's confidence about their job situation.
If the shoe to drop is going to be deterioration in the labor market, that could potentially happen this summer. So do you think the Fed needs to actually really start considering getting ahead of this and lowering rates?
I think the Fed is kind of deer in the headlights because, obviously a tariff increase is a shock that both hurts the economy and increases inflation. And I think at this point, they're not 100% sure which one they need to fight. As long as the economy's muddling through, I think they're going to focus on inflation. As I said, I think for me, the critical thing is at what point do the inflation numbers start to normalize again after we get that one-off burst of price increases.
So you think the bias for the Fed right now is actually on prices, not the job?
Yeah, and that's not to suggest I think the Fed is going to hike rates, but I think the Fed is holding steady at a time when they believe that policy is modestly restrictive. So if in that mode, if the economy were to weaken, ordinarily you would expect the Fed to begin cutting rates pretty promptly. And I think their hands are somewhat tied because of the inflation picture. If they get a reassurance that the inflation numbers are likely to come back down pretty quickly, then I think they have a much freer hand to ease if they need to.
How much do you believe that what we're hearing from Chris Waller is the mainstream of the Federal Reserve, given the fact that he's talking about the good kind of rate cuts, possibly later this year?
Yeah, my sense is that he's a little bit outside of the mainstream at the moment. I have to say, I've been surprised at how little sentiment there has been along the lines of what Waller has been saying. Waller is basically continuing to press the case, the textbook argument that tariffs are a one-off increase in prices, not a persistent change in inflation. I thought we would hear that a lot more out of the Fed, and in fact, most Fed officials have been saying we're not willing to assume that. And you can understand after what happened in 2021, 2022, once burned, twice shy, that the Fed isn't willing to just make that assumption. But I have to say, I thought we'd hear more of what Waller's saying and less of what we're hearing from a lot of the other officials.
But when the Fed was making those assumptions, it's because of COVID. Tariffs in Trump 1.0 was a one price shock. It wasn't this pattern?
I would argue the big difference between then and now is the trillions of dollars of money that was injected into the system, right? I mean, in theory, a series of logistics problems like we had during COVID should have been a one-off. And the reason it wasn't is because at the same time that you had this going on the supply side, you also had this unprecedented injection of liquidity into the system. Obviously, we don't have that this time. So, I think the situation is different, but at the same time, if you're the Fed, it's hard to credibly argue, well, we said transitory a few years ago, and we see how that turned out. We're going to say transitory again. I think they've felt like they didn't really want to take that approach.
Steve, it's also hard not to argue that there's some sort of political bias, even maybe on the side of Waller, who maybe wants to be the next Fed chief, or on the side of everybody else who doesn't want to seem like they're endorsing Trump's strategies of tariffs. Is there politics seeping its way into a body that likes to insist that politics is not part of their decision?
Yeah, I think the Fed is absolutely doing their darndest to make sure it doesn't. But sometimes, as you say, sometimes even if it's unconscious, maybe you're resisting cutting rates because the president is demanding it, and you don't want to be seen as following that what they might view as a bit of a dictate. But I think that the Fed has been under some degree of political pressure, certainly for my entire career, and I think going back much longer than that. So the institution understands that, and I think navigates that pretty well in general. I think Chairman Powell has been as deftly as possible trying to navigate what are unusually stormy waters, I guess we could say, in the last few months, and we'll see how that plays out.
Stephen Stanley of Santander, thank you so much for being with us. Really appreciate it.
My pleasure.
Stormy waters. I will have that in my head for the rest of the morning, and I'm sure some people would describe it a bit differently. It's been a pretty tumultuous time for Jerome Powell over the past couple of weeks.
Yeah, it feels more like he is on the deadliest catch and trying to fish crabs out as waves come and crash over him. I feel like that's the metaphor that I'm envisioning in my head.
Right now, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Russia and Ukraine are meeting in Turkey for peace talks. The talks come after a Ukrainian drone attack destroyed more than 40 planes deep in Russia's territory, and a Russia attack against Kyiv killed at least 12 people. Meanwhile, Morgan Stanley predicts in a year from now, the dollar will tumble to levels last seen during the pandemic. They see the U.S. dollar index falling about 9%. Strategists there also predict 10-year Treasury yields will reach 4% by the end of this year and decline further next year with 175 basis points of rate cuts from the Fed. And billionaire Elon Musk says he is not using ketamine, disputing a report by the New York Times. It reported on Friday that Musk had used drugs more heavily than previously known during Trump's presidential campaign, and that he took ketamine often and used ecstasy and psychedelic mushrooms on occasion. Musk wrote on X, "I tried prescription ketamine a few years ago and said so on X, so this is not even news." That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. I have to say, he's got a great T-shirt game. The Doge Father, I'm telling you, like he always comes out with these sort of self-made T-shirts.
Right. I think for the Oval Office, though, potentially suit and tie might be more appropriate.
Yeah, here we go.
Plus a trucker hat, suit, tie, hat.
Of course. Yeah. Style police over here. Up next, setting you up for the next week, for the week ahead. Plus, Winnie Caesar of Credit Sites as the bond market looks for policy clarity. Good luck with that. This is Bloomberg Surveillance. Counting it down to the opening bell. Right now, we're looking at futures that are just lower a touch as people try to parse through what we know, what we don't know about policy. What we don't know is whether this trade truce is going to stay, although some of the earlier weakness really coming back. NASDAQ futures down just 0.4%. We can see, counting you down to the opening bell, 10 a.m., we've got ISM manufacturing Tuesday, durable goods and JOLTS, the job openings data. Wednesday, ADP employment data and ISM services. On Thursday, the trade balance and another round of jobless claims. Watch out for the continuing claims in particular. Plus, German Chancellor is meeting with Trump at the White House. And Friday, the big one, it's the pay non-farm payrolls report. Turning now to Capitol Hill, Treasury Secretary Scott Bessent saying the U.S. is never going to default as the deadline for increasing the federal debt ceiling approaches. Winnie Caesar of Credit Sites writing, we still think that 4.75% is a reasonable target for 10-year Treasury yields as we see increasing term premium fueled by higher deficits and evolving risk associated with the U.S. fiscal trajectory. We were looking for a potential bond vigilante. Maybe we just found one. Winnie joins us now for more. Winnie, we've heard so much about the bond vigilantes screaming a big scream, but not actually getting in the game and coming in to buy when they finally decide that there is going to be no change. Why is this time so different?
Well, I think this time is different because of the change in expectations around institutions. We have some fiscal policy on the table in terms of the extension of tax cuts and incremental tax cuts that I think a lot of people are looking at and a little bit skeptical about the corresponding growth that may come with it. We have a lot of skepticism around the trajectory of tariffs. Are these good? Are these bad? What is the ultimate goal for the U.S. and global economy? And then we also know that there is an awful lot of supply that needs to come for Treasury funding, especially if yields remain elevated. And while I don't think that we are going to see bond vigilantes really outright selling, just having some buyers strike is not particularly helpful for yields.
Well, it's not just U.S. supply, Winnie. This week on Tuesday and Thursday, we'll get 10 and 30-year auctions, respectively, in Japan, a 40-year gilt in the UK on Tuesday. Have these become big risk events for American markets as well?
I think that the move higher in yields really globally has become something that people should focus on much more closely. Now, we're not expecting auctions to fail or, a massive investor strike from any of these auctions, but looking at the clearing levels and also looking at kind of what central banks are saying about the trajectory of policy combined with what is the long end actually doing. Are we seeing these incredible steepening moves? That's always something to pay attention to overall.
As that happens, as we continue to see Treasury yields grind higher, does in turn credit spreads, do you expect them to continue to grind tighter too, Winnie?
We do not. So we have been expecting to see more credit spread volatility this year than last year, especially. That's not a heroic call given how benign the volatility environment was last year. But a few different factors are really supporting our view. First of all, if we see uncertainty around broader policy, both monetary and fiscal, that is not particularly helpful for corporates trying to make decisions around their capital spending and also forecasting. We're not seeing the type of massive consolidation and intentional releveraging that is usually correspondent with wider spreads. But we are seeing a pretty significant uptick in uncertainty. And we're at a little bit of an inflection point in terms of fundamentals. I would say that fundamental starting point right now is pretty good. We haven't seen a lot of that kind of bad or intentional releveraging behavior. But if we start to see some softening in growth expectations and top line revenue, while at the same time costs are just not coming down at a similar level, that can be really challenging from a profit margin perspective. And we also think will probably weigh on spreads as investors start to assess ratings trajectory and a potential default cycle rising a bit.
Winnie, how much does this have to do with actual credit fundamentals and how much does it just have to do with international flows and this question around whether so many Japanese and other life insurers are going to be coming to the U.S. credit markets for yield?
I think that the supply and demand dynamics, so the technical side of the equation, and fundamentals are always very linked. When you have a strong technical backdrop like we had last year, where there was just robust demand for corporate credit, for risk assets more broadly, that provided really great access to primary markets for a wide range of issuers, from investment grade all the way down to high yield and broadly syndicated loan, including some CCC stressed and kind of cuspier issuers. And when that type of liquidity starts to fade or outright reverse, you do start to run into more fundamental challenges overall. So I think that there is kind of a dual impact on both the technical and the fundamental side.
When it comes to where you think the 10-year yield is going, you say 4.75%. You think it's a reasonable target based on what's going on with the deficit and fiscal policy. But what about what's going on with trade? Because we have seen the bond market push back on all of the trade headlines. And right now we're going into a week where we're a little bit uncertain where the United States stands with China.
Yes, it's yet another week of uncertainty, which just seems to be the name of the game in 2025. So we have never fully embraced kind of the hard landing recession scenario associated with trade. We do think that the administration is attempting to negotiate new trade policy. Now, there's a lot of question marks around what that means for relationships with countries like China and some of our more kind of friendly countries like within Europe and Canada, et cetera. But what we think is bond yields are probably going to stay a bit elevated, that the expectations around the fiscal side of things are probably going to matter a little bit more coming into the summer months as we have more understanding of what the Senate would like to include in the big, beautiful bill. And the convergence of all of those different factors are probably going to push long end yields higher, especially as we start to see a little bit more sticky inflation data, especially on the good side of things, come through the broader economic data. And the Fed continues to message its contentness to be on hold for the foreseeable future.
Winnie Caesar of Credit Sites, thank you so much for being with us as we look for who's going to buy those 30-year bonds, because right now not a lot of people want them. And we've been hearing these concerns about how much this is tied to the deficit. One of the highest profile people to raise a concern was Jamie Dimon, the head of JP Morgan, who said that the U.S. bond market will crack under the weight of the deficit, cautioning regulators, you are going to see a crack. I'm telling you this is going to happen and you're going to panic. I'm not going to panic. We'll be fine. And this is a man who came out in an interview was aired this morning saying that his retirement from the top post at JP Morgan is several years away, but the decision is up to the bank's directors. Danny, it's up to God and the board. I love what I do.
I kind of preferred it when he kept saying it was 5 years away. It's a little bit weird to be like, it's up to God and the board. I wonder how the board feels about that being the order of importance. They might think that they come before God. Yeah, it's a little bit morbid, I would say.
It sounds a little bit like a monarch, when you're ordained by God, and that's when you think that that is the end to your reign. I will say it might be advantageous for Jamie Dimon to wait for potentially as an administration that he could join, because then he can defer capital gain taxes or any divestments required under the ethics rule if you're moving from the position he is in into government.
Well, in the meantime, he's looking at the same kind of uncertainty that we all are. And I have to say that coming up on this week, it would be about non-farm payrolls, but it isn't about non-farm payrolls as much as all of these other headlines, because frankly, the economic data, Danny, has been such a question mark in terms of how to even understand it in the broader scheme of things.
Yes, but I go back to this thing of at what point do we just get headline fatigue? That every piece of data that comes in, you say, I can't trust it. That every headline that comes in from the Trump administration, you say, well, it's a negotiating stance, he'll change. That you just go back to earnings were really strong, so I'm going to keep buying.
You pick out that one thing that you like and you keep going after it. Coming up tomorrow, Cameron Dawson of New Edge Wealth, Chris Harvey of Wells Fargo Securities, Marriott International Chief Executive Officer Tony Capuano about the demand for travel, and Tom Kennedy of JP Morgan Asset Management as we figure out what the new adventure is for the new day. This was Bloomberg Surveillance.